done next to Gary and share with him.
Good afternoon. I think we'll go ahead and get started. I want to start off by thanking everyone for being here this afternoon. I know travel in from either New York or Chicago was not easy this morning, so really appreciate you all being here. Today is our 13th meeting of the Global Markets Advisory Committee. This advisory committee was created in 1998 to report and make recommendations to the Commission to be utilized by the Commission to obtain input on international market issues that affect the integrity and competitiveness of U.S. markets and U.S. firms engaged in global business. It is interesting to look back at the agendas of the past 11 years to note that in June of 2004, the discussion revolved around global clearing and regulatory coordination between nations. While the issues we are struggling with today have been brought into focus by the financial crisis that unfolded over the past year, it's somewhat daunting to remember these issues have been at the forefront of importance with respect to the futures markets for many years. We are meeting today to obtain the views of the committee members on bankruptcy issues, with an emphasis on how the insolvency regime in the U.S. compared to the insolvency regime in the U.K., particularly in the case of the bankruptcy of Lehman Brothers Holding and Lehman Brothers International Europe. We will also discuss global financial regulatory reform. This dialogue could not come at a more crucial time for market regulators as we consider the proposals for harmonizing regulation and closing regulatory gaps. Policymakers face the challenge of reshaping financial market oversight to better serve the public by strengthening regulation where needed and eliminating inefficiencies where possible. The questions surrounding most issues are enormously complex and require thoughtful resolutions. Comprehensive financial reform will not be easy, but it is moving forward, and I believe reform is important to restore confidence in the system. International coordination is also essential to ensure comprehensive regulation of the over-the-counter derivatives markets. We must not leave gaps in our regulatory structure that allow traders to evade one country's regulations by taking their business elsewhere. The Commission has been working not only with our fellow regulators here in the U.S., but with our international counterparts to prevent opportunities for regulatory arbitrage. Through discussions with regulators in Europe, we have found that proposals in the U.S. and in Europe are complementary. And we're pleased to tell you that today with us is David Wright, the Deputy Director General for Internal Market and Services of the European Commission, to discuss issues of mutual importance to U.S. and European policymakers. And joining Mr. Wright is Patrick Pearson, Head of Financial Markets Infrastructure at the European Commission, and Sebastian Hervarten, Administrator of Financial Markets Infrastructure of the European Commission, and Peter Kirstens, the First Counselor of Economics and Finance with the delegation of the European Union to the United States. The Commission is honored to be hosting our colleagues from the European Commission, and we hope for a productive discussion comparing and contrasting the European derivatives proposals with U.S. proposals. I'm now going to turn to my fellow commissioners, but first want to welcome, we have 3 new members of GMAC that are joining us today. David Donlick from the Boeing Company is here with us. Don Wilson from DRW Trading is with us, and Jiro Okoshi is here from Revolve. So thank you to all 3 of us for your participation in the GMAC, and we welcome you here today to be with us. I'm now going to turn to our chairman for opening statement.
Thank you. Good morning. Thank you, Commissioner Summers, for chairing today's meeting of the Global Markets Advisory Committee. This is my first GMAC meeting as chairman of the Commission. I look forward to today's discussion. I think I've met many of the committee members before, but look forward to getting to know each of you, and I too welcome Don and David and Jiro to the committee. I also want to give a particular warm welcome and thanks to David Wright, who not only for all the reasons Jill said about the need for coordination with the European Commission and being here today, but I also want to thank you because the last time I saw David was in Brussels, where I was honored as he invited me over to speak to a group as the European Commission's Conference of Over-the-Counter Derivatives Reform. He did put me in a room with about 400 people and put me on the dais, and then they didn't let me leave for 3 or 4 hours. And I took a lot of very interesting and probing questions from end users. But I really, it's a great honor, David. You're here with your colleagues, Sebastian and Patrick, and is it Pierre or Peter? Peter. And I look forward to ongoing cooperation with the European Commission on bringing comprehensive reform to the over-the-counter derivatives marketplace. I mean, last year's financial crisis really just reminded us what we knew, that our financial markets are global in nature, capital and risk knows no geographic boundaries, and that what we have to do to respond to the worst crisis in 80 years is a response which needs to be global. In the United States, our legislative process is in full swing, as you know. This week, the House of Representatives is debating the regulatory reform package that introduces comprehensive reform for over-the-counter derivatives for the first time. It is truly historic what the House is taking up this week. The Senate, of course, will have their process and their own procedures. And hopefully with the support of the House later this week, the CFTC will continue to work with both chambers, providing both advice and technical assistance to bring the most comprehensive and effective reform forward. Fortunately, I think it's that the U.S. is not alone in this. And in October, the European Commission, with a lot of help from the 4 gentlemen that are in the room here, announced a broad agenda of regulatory reform in derivatives. The Commission's plan included similar provisions to what we have been recommending here. So though we have different cultures and different political systems, we're dealing and grappling with the same problem, and it appears, I'm very optimistic, it appears we're coming to the same suggested solutions. The Commission proposals include central clearing, I should say mandated central clearing of derivative transactions that are standardized. It requires higher capital for customized over-the-counter derivatives transactions and mandates trading of all standardized transactions in regulated trading venues. So I'm very encouraged that we're moving in the same direction. Now again, though we have different cultures and political systems, we've been coming together with a consensus, and we're going to continue to have dialogues, and today is an important part of that as well. I think reform starts with bringing transparency to these opaque markets. Economists for decades have recognized that market transparency benefits the public. And if derivative users knew what others were paying to enter into similar contracts, would they not receive better pricing on their transactions? Isn't that really at the heart of what we're trying to do? I mean, whether it's a small municipality or a retailer or an oil company, they would all be able to make better decisions on their hedging. They would get better pricing on their contracts if it was based upon reported pricing in a broader market. I mean, could you imagine an investor buying 100 shares of a security and not knowing where the security just traded? Would you even go into a store and buy an apple if you didn't know where the pricing of the apple was? But that's exactly what we ask end users to do in the derivatives marketplace right now. I don't know. I mean, the bill before the House does a great deal. It subjects Wall Street banks to broad regulatory requirements, and also subjects Wall Street banks to a transparency requirement trading with each other, where Wall Street banks trading between Wall Street banks would have to be brought into regulated trading platforms and clearing. But as Congress continues to debate regulatory reform in the over-the-counter derivatives marketplace, I believe it's critical that we also bring this to the transactions with the end users, that we not have exemptions from mandatory trading requirements for standardized transactions. I think that the only group that really benefits from these exemptions is Wall Street, and that end users, whether they be small municipalities or the largest corporation, benefits from transparency in these marketplaces. So during today's meeting, I look forward to hearing participants' views on the global financial system. I specifically would like to hear thoughts on how we're progressing and how that works in an international context. And I know that I've heard from some of the organizations represented around the table that the U.S. should not reform our regimes until foreign regulators reform theirs. I actually think it's in reverse. I think that if we don't reform our regulatory system, others around the globe will fail to reform theirs. And we've got a great consensus right now. I thank our friends from Europe for being here and all the committee members, and I turn it back to Jill and my other commissioners.
Thank you, Mr. Chairman. Commissioner Dunn?
Thank you, Madam Chairman, for convening this Global Market Advisory Committee. I look forward to hearing from the experts gathered here today and hope that their thoughts and insight can help to inform the Commission on recently confronted bankruptcy issues and on the various over-the-counter derivatives proposals. It is important that we take the time to look at the global impact that the financial meltdown has had on the sector of the financial market that the CFTC regulates. We need to review the lessons learned and understand the shortcomings of our current domestic and global regulatory regimes. And most importantly, we need to work with regulators around the world to address those issues that are identified. While Thomas Friedman's notion that the world is flat has gained mainstream acceptance in recent years, it is also clear to me that not only does equal opportunity exist in our global marketplace, but also a degree of interdependency. What we do here in the U.S. affects markets around the world, and actions taken around the world affects markets here. Accepting the existence of global interdependency, we as regulators must work harder to understand developments around the world and be more cognizant of the global effects that our own actions may have. The world's regulatory bodies must work in harmony to address needed changes to prevent future financial crisis. And if one does arrive, be prepared to face it on a global playing field. Today, we'll examine some of the concerns that became evidence over the last couple of years and discuss what actions are necessary to address these actions. We're really taking our cue from the heads of states. At recent G8 and G20 meetings have resulted in heads of states calling for the need for regulators to address excessive price volatility in energy and agricultural markets. The September G20 called for work by regulators in 4 areas: collect data on large concentrations of trader positions on oil commodity markets, implement a data collection system covering OCT oil markets, publish more detail and disaggregated data, and analyze the issue of excessive volatility and review of possible measures to prevent market manipulation. The International Organization of Security Commissions has reconvened its Commodity Futures Market Task Force to address the G20 directives. If we are to make headway in providing true global reform, it is important that we embrace this notion of global interdependency and work together to diligently and quickly provide the world meaningful financial regulatory oversight. Today's meeting is a milestone in the journey to achieve that end. I thank all of you for your participation and work.
Thank you, Commissioner Dunn. Commissioner Chilton?
Thanks, Madam Chair, and welcome to everybody, particularly our new members. And thinking about sort of half of the continental United States is encumbered with some sort of severe weather today. I'm pleased that everybody was able to get here or will be here. It made me think of a talk I gave last year, which was entitled Driving on Ice. And what I said about regulatory reform, the analogy I tried to make was that when you're driving in bad weather, when you're driving in ice, that maybe if you veer too far one way, and I made the analogy that we maybe veered too far to the right since 1999 with banking and mortgage and deregulating credit default swaps, that we need to be careful not to oversteer and to go back too far. That the middle of the road sometimes is a good place to be. And I think there's a recognition that there are appropriate guardrails on this road to regulatory reform, this metaphorical road to regulatory reform, that we can all agree on. Whether or not we're first or the EU is first, it doesn't bother me. I associate my remarks with the chairman. I don't have a lot of trepidation about going first as long as we do it in a fashion that isn't overzealous. The first speed limit in the world was in Britain. It was 2 miles an hour in 1865. That's in the city for horseless carriages. 4 miles an hour in the country. And you had to have 3 people, 2 drivers, and another fellow walking out in front of the horseless carriage with a red flag, waving it. Now, that's overzealous. So, as long as we are thoughtful and keep in mind what our end game is, and that's protecting consumers, and to my mind, protecting consumers means ensuring that the commercial interest, the reason these markets sort of began, are able to legitimately use the markets to hedge the risk and price discovery, and that it doesn't ultimately become what people are concerned about it, justifiably or not, a private jungle gym for speculators to play on, that I think we'll get it right. And particularly if we look, if that wasn't enough reason to move forward with thoughtful regulation, if you look at what's been going on just this week in the U.S. with EPA in their designation of carbon and what they're talking about in Copenhagen, and Commissioner O'Malley may have a better clue than I because he's been up on the Hill more recently, but I wouldn't be surprised if we don't have some sort of cap and trade bill at some point. That could equal a $2 trillion transactional market, the largest physical commodity market in the world, larger than crude oil. So without additional authority, like the chairman was talking about, from Congress, additional rulemaking changes from the CFTC, without the additional staff that Commissioner Dunn's talked about so many times, the additional resources, there's a whole host of problems that we can open the door for. But in summation, I'm not worried about going forward. As long as we get it right, as long as we keep our eye on the ball and think about, we're going to protect consumers, and I think we'll be fine. Thanks, Madam Chair.
Thank you, Commissioner Chilton. Commissioner O'Malley.
It's no fun following Bart.
Really 1865, though?
I don't think it was 4. I think it was in kilometers at the time. So.
I asked the question. We've got a footnote.
Okay. Thank you, Commissioner Summers, for organizing this meeting, and I appreciate the willingness of all the participants, including our friends from Europe, to join us today to share their views and knowledge with the Commission regarding the state of our global over-the-counter markets and the opportunities for regulatory reform. In response to the financial crisis, both the United States and the European Union regulators have recommended significant reforms to these markets. Both proposals seek to better manage risk, increase transparency through improved trade reporting, and expand the use of clearing to minimize counterparty trading exposure and reduce systemic risk. This meeting is timely and will provide the Commission with the opportunity to compare U.S. and EU proposals to regulate these increasingly global markets. According to the Bank of International Settlements, the global OTC market size is estimated at $600 trillion. Over 90% of the Fortune 500 companies use these products in the course of business to hedge risk, manage global commercial activities ranging from interest rates, foreign exchange, commodities, and the CDS market. As regulators, we must be cognizant that the U.S. is not the center of all trading and markets. In fact, 80% of all OTC trades by value are executed in markets outside the U.S. Interest rates make up $420 trillion of the $600 trillion OTC markets, with over 74% of trades done overseas. Foreign exchange trades are worth $50 trillion, and with roughly 85% of trades executed outside the U.S. We must ensure our cross-border rules and regulations do not offer opportunities for regulatory arbitrage or undermine U.S. competitiveness. I hope to see a regulatory framework put in place that will establish clear market rules for years to come and to enable these markets to serve as a cost-effective mechanism in managing commercial risk. The rules we put in place today also must expand our capability to identify and manage systemic risk for the future. I'm pleased to have several experts here to provide the views on U.S. and regulatory reforms, and I look forward to their presentations. Thank you.
Thank you, Commissioner O'Malley. I want to take care of a couple of housekeeping items. The microphones, I think, will not work if there are more than 2 on at one time, so when you're finished speaking, if you'll just turn your mic off. If you have a question, if you'll raise your name placard, we can call on you for questions And for the court reporter, if you could introduce yourself before asking a question. Excuse me. I'm going to have everybody introduce themselves around the table, but I first wanted to check. We have a couple of members that I believe are participating via telephone. Jim Newsom, former CFTC chairman and CME board member. Jim, are you on the phone?
I am on the phone, Commissioner.
Great. Thank you, Jim. And Mike Dolly, who's chairman of the FIA, I believe was also going to participate via telephone. Mike, are you there? Maybe not. Okay. And we are supposed to have Roger Liddell via video conference for this part of the meeting as well. So hopefully that will be hooked up shortly. So I'll start with Eric, if you'd like to go around the table and everyone introduce themselves.
I can hear you and see you, but I don't know if you can hear or see me. Roger.
Oh, okay, great. Roger, thank you. Thanks for being with us.
Thanks, Commissioner. Eric Vincent, I'm president of Osprey Management and board member of the Managed Funds Association.
My name is Thomas Callahan. I'm executive vice president of NYSE Euronext and CEO of NYSE Life US, the U.S. derivative exchange of NYSE Euronext.
Good afternoon. My name is Jiro Kochi. I'm the CEO and co-founder of Reval.
Good afternoon. My name is Bob Klein. I'm a managing director and counsel at Citigroup.
I'm Joanne Madero. I'm managing director of BlackRock.
George Crappel, co-chairman and co-CEO of Milburn Ridgefield. We're a CTA and CPO. I'm also on the board of the FIA and the NFA.
My name is Ronald Filler. I'm a professor of law now and director of the Center on Financial Services Law at New York Law School.
I'm Jackie Mesa, the director of international affairs at the CFTC.
Bob Wasserman, associate director and DCIO here at CFTC.
My name is David Wright. I'm the Deputy Director General in the European Commission dealing with financial markets.
I'm Dave Danilek, Treasurer of the Boeing Company.
I'm Bonnie Litt. I'm a Managing Director and Associate General Counsel at Goldman Sachs, and I'm also President of the Executive Committee of the Law and Compliance Division of FIA.
I'm Dan Roth from National Futures Association.
I'm Donald Wilson. I'm the founder and CEO of DRW Trading, which is a proprietary trading group. We focus on providing liquidity in exchange-traded markets.
Thank you, everyone. I'm going to go ahead and get started with the first part of our meeting, which is having Jackie give us an update on IOSCO issues. Thank you, Jackie.
Thank you, Chairman Summers. I was hoping that maybe you just ate right through my time and I would just sit here and pleasantly smile at everyone. But seeing that you're still going to want me to go forward, I wanted to provide today an update on IOSCO issues. And IOSCO has been very busy in the last year, as you can imagine, so I won't go through everything they're working on, but sort of what they've been doing post-crisis. In response to the G20 call for action, IOSCO formed 3 task forces, one on unregulated markets and products, one on unregulated entities, and one on short selling. The CFTC participated in 2 of those, unregulated markets and products, and the task force on unregulated entities. Both task forces have released final reports adopted by IOSCO. In the unregulated markets and products report, it focused on 2 instruments that were viewed to be at the core of the crisis: collateralized debt obligations and credit default swaps. On CDOs, IOSCO felt that because CDOs contained such complex leverage that even accredited investors sometimes had difficulty understanding the risk, IOSCO recommended several things. 1, to improve disclosure. 2, encourage members to reconsider the standard of sophisticated or accredited investor. And finally, asked regulators to examine incentives, and that's typically known as the skin in the game requirement. Regarding CDS, IOSCO encouraged standardization of products. For those that were standardized, encouraged clearing and exchange trading of those CDSs, and recommended that counterparties have appropriate capital and margining for non-standardized products. As you can see, I think the U.S. and EU and other countries have moved generally in that direction, which was the agreement of regulators very early on, right after the crisis. Currently, both of these task forces are considering monitoring the implementation of the recommendations and are considering particularly with the unregulated markets and products, if this can be expanded to all OTC products. On unregulated entities, in June 2009, the TC endorsed and published a report and recommended 6 principles for hedge fund regulation. 1, that hedge fund managers should be subject to mandatory registration. 2, that hedge fund managers, which are required to be registered, should be subject to appropriate ongoing regulatory requirements. And there are a number of details which I won't go through there. That they prime brokers and banks providing funding to hedge funds should be subject to mandatory registration and regulation, and a public oversight system, and have in place appropriate risk management systems and controls. That hedge fund managers, advisors, and prime brokers should provide to the relevant regulator information for systemic risk purposes. This is the area that IOSCO is working on now and trying to go forward on a united front on what information they're going to collect from hedge funds. 5, that regulators should encourage and take account of the development, implementation, and convergence of industry good practices where appropriate. And 6, that regulators should have the authority to cooperate and share information. IOSCO is also updating its 30 principles for regulation for securities and futures regulators and is going to adopt at least 3 new principles. 1 on systemic risk, 2nd on the perimeter of regulation, and 3rd for credit rating agencies, auditors, and other quote-unquote information providers. There are also separate standards for clearing and settlement systems, the IOSCO CPSS standards. These are also going to be under significant review. Right now, IOSCO is reviewing these standards to update for OTC clearing, but during this update discovered that there were a number of areas that needed significant review and update, and have agreed to go forward and revise those principles. I'm going to address a couple of more areas IOSCO is looking at. One is direct electronic access, and the reason I'm pointing this out is because this was the subject of the last GMAC meeting where we had significant discussion. IOSCO did put out a report in this area for consultation, and one of the primary recommendations was that markets should not offer direct electronic access unless they can ensure automatic pre-trade controls that allow the responsible firm the ability to limit the market member's exposure. Although a majority of commentators supported the proposed principles, some objected to mandating the use of automated risk limits controls as an infringement on their activities. The standing committees are still looking at comments and deciding what is appropriate given the high-speed algorithmic trading that occurs today, and making sure that regulators are up to date and in their rules and regulations. And finally, the last point I'm going to talk about is the Commodity Futures Markets Task Force, and it's the subject that Commissioner Dunn highlighted in his opening remarks. This was a call by the G20 to specifically look at oil markets and how regulators can handle the volatility over the last couple of years in the oil markets. Specifically, they asked for us to look at large concentrations and to look on exchange and over the counter. We met just Monday in London, so sorry if I look a little tired. I just flew back, and some of you flew here today as well. And it was a very good meeting, and there was substantial progress made during the meeting on Monday. Regulators are seriously going to take steps to look at oil trading and over-the-counter markets, to actually aggregate that data and put it forward for the public, and to make sure that they are properly looking for manipulation and other abuses in the oil markets. So that's it for me. Thank you.
Thank you, Jackie. Does anyone have any particular questions on the IOSCO projects that are ongoing? If not, we're going to move on to the first part of our meeting, and we are honored to have Ron Filler, who is a longtime member of GMAC, back with us today. Thank you for being here, Ron, to participate in this. He's going to give us an overview of the bankruptcy issues associated with Lehman Brothers bankruptcy that happened last year.
Thank you, Commissioner Summers. As I mentioned, I am now a professor of law, but I think the reason I was asked to come here is before joining the faculty at the law school, I was a managing director in the Capital Markets Prime Service Division at Lehman Brothers for over 15 years, where my responsibilities included a variety of business and legal issues affecting Lehman's global futures business. So I hope to use those perspectives, and during my 30-plus years in this industry, I've had the opportunity and privilege of serving on a number of governmental, exchange, industry, and clearinghouse boards and advisory committees. And I want to thank Commissioner Summers for using this forum to bring this issue to this discussion. This issue goes to the very heart and purpose of our industry, and that's providing soundness and safety to customers who trade not only futures, but this issue also has got to be addressed by this agency and, as Commissioner Summers mentioned, by global regulators as you tackle concepts like portfolio margin, deal with the OTC clearing issues, when you deal with the concept of segregation and the role that segregation should or may play in connection with these and other concepts. So it's a very important issue, and it's a global issue, and the task before this committee is a very challenging one because of the global issues and the differences in the bankruptcy laws that exist around the world. So let's go back to September the 15th, 2008, a little over 15 months ago. Seems like a lifetime. But on Monday morning, September the 15th, 2008, as you may remember, and I have a paper for you that has a lot of the facts in it, Lehman Brothers Holdings, the parent holding company of Lehman and of all of its affiliates, files for bankruptcy. And many of the Lehman subsidiaries around the world also file for bankruptcy that same morning. Lehman Brothers, Inc., the regulated broker-dealer and FCM, does not file for bankruptcy. It still has the necessary capital to play the game, although by the end of that week, on September the 19th, that entity, the LBI, also files for bankruptcy. And while Lehman has, I think when we filed our org chart listing all the different maps, the material affiliated persons, it's probably a chart of some 200 different companies. I want to focus just on those Lehman entities that held or dealt with futures clients. So you have LBI here, Lehman Brothers Inc. in the U.S. You have Lehman Brothers International Europe, or LBIE, or Lehman London. You have Lehman Brothers Japan, which was the clearing member of the 3 exchanges in Tokyo. You had Lehman Brothers Futures Asia Limited, which was the clearing arm in Hong Kong. And you had Lehman Brothers PTE, which was the clearing firm on the SGX exchange in Singapore. And the way the Lehman system was structured from a futures perspective, only LBI and LBIE held client accounts. LBI probably had about 65% of the business, and LBIE had about 35% of the business. And also what's important in this, thinking about the structure and the issues that we're about to talk about, LBI would then have a customer omnibus account with each of the other Lehman affiliates around the world that acted as the respective clearing member on those clearing houses. And to the extent Lehman did not have a clearing membership on some of the exchanges, where we use a third-party clearing firm, LBI would have the customer omnibus account with those third-party firms. So LBIE was the clearing arm for Europe. LBI was the clearing arm for the U.S. and had the relationships with all of the other Lehman affiliates, primarily in Asia. So when Lehman Brothers Holdings filed for bankruptcy, and if you also got to remember, Monday, September the 15th, the markets were extremely volatile that day. So I think it's best in looking at the picture and to try to figure out what issues, what reforms, what concepts need to be addressed. I like to separate what happened here in the U.S. and then look what happened outside the U.S. for discussion purposes. In the U.S., I think with the exception of one small glitch, which we're going to talk about, the system worked pretty well. Monday morning, and Lehman's client business was strictly institutional, probably some of the premier mutual funds, pension plans, state retirement plans, money managers, hedge funds, corporations, and governments. I mean, we really had, I consider it a premier list of institutional clients. Many of them had multiple clearing relationships. So they would be not only using Lehman as their clearing firm, but they would have clearing relationships with other clearing firms on the street. And those firms that had clearing relationships with those clients that had accounts with us that also had an account at another firm, Obviously, with the news breaking that morning, they started sending us what we call in the industry, an ex-pit transfer letter, requesting that their open positions be transferred off the books of Lehman, LBI, to the other clearing firms. And as in the course of that week, that's what happened. Monday night, the positions that we got letters for were moved to other firms. Tuesday morning, that happens after the close of business on Monday. Tuesday morning, we all come in and the positions were closed out, and therefore no open positions remain on the books of Lehman for that account. We then transfer the assets that we use for margin, cash, and collateral to the clearing member that received those positions on the close of business that night. Tuesday during the day, same thing happened. We got another lot of requests, and Wednesday morning we transferred the funds. Wednesday during the day, we got more requests. Everything was working smoothly until Thursday. And that's the one glitch that, to be honest, I don't have an answer for you. I know it's an answer or an issue that maybe the commission is looking at, but our custodial bank, JP Morgan Chase, for whatever reason, and I've never seen the reason behind it, froze the assets that were held in the segregated account. And so while all the positions got moved that week and the monies had been flowing out in a very smooth way Monday, Tuesday, Wednesday, and so forth, on Thursday those assets were frozen. But through the great efforts of the commission staff and others in the industry, about, was it 8 or 10 days later, JP Morgan eventually did move the position, the cash and collateral that we held with that bank over to the respective clearing firms that received it. So addressing the U.S. approach, I would say the systems work. The laws dealing with segregation, the regulations dealing with segregation under 1.20, it worked for the most part and very successful. And by the close of business on Friday, September the 19th, if you recalled, after the close of business that day, those clients who did not have a clearing account at another firm, all of their positions were moved to Barclays Capital, which bought all of the client assets and accounts at Lehman after the close of business on that Friday. So by the close of business of that week, the great news is all the positions and eventually all of the monies flowed over to the customers and clearing firms, I should say, where the customers now had accounts. So the system works here, and it worked pretty well. Now let's turn our attention.
Could I just ask one quick question?
Sure.
What portion moved during the week versus the Barclays portability at the end of the week?
You mean the last part of the piece?
Yeah. I mean,
The answer, Chairman Gensler, is there was just those client accounts that did not have a multiple clearing relationship. I don't know the exact number, but I'd probably say it's about 25-30%. Maybe wrong on that number. It's a guess on my part.
Right. So the majority, maybe 70-75% had moved already.
Correct.
And then 20
This was just, and it was impossible for those firms or clients to open up an account that quickly that week with all the things going on. And with Barclays acquiring all of the accounts that still remain on the books of Lehman that day, the good news is all the client positions got moved healthily.
Right. And just to clarify, this is all just futures. It's not what happened with prime brokerage or swaps.
I'm a futures guy.
All right. All right.
No, the swap world we're still dealing with. And it's interesting what you raised because the equity world is slightly different than the futures. And, a lot of people will say, boy, it took 5 days to move those futures positions. To me, that's a good thing. Some people say it should have been done in 1 day or 2 days or 3 days. But when you compare the futures regime to even the equity regime, it's a much better regime to facilitate transfers of both positions and collateral to another firm. Outside the U.S., we got a bigger issue. And that issue, I think if you talk to any lawyer in this room prior to September the 15th, you would have gotten a different answer to the question I'm about to raise or the issue than what we now know. And what we've learned post-Lehman is that the bankruptcy laws trump all the regulations that we have in place to protect customers. And the bankruptcy laws in London and Japan and Hong Kong preempted all of the rules and regulations and customer protections that we thought were in place within the connection with both not only LBI but LBIE clients as well. London, as you know, UK has a client money rule regime, which is very similar to the segregation rule here. There are some subtle issues dealing with what happened in London, but the concepts of customer protections are quite similar between London and the U.S., but the bankruptcy laws differ significantly outside the U.S. versus what we have here. And if you think about it, one of the more forward-thinking concepts that we have here in the U.S. regarding bankruptcy laws, we have specific provisions under the U.S. Bankruptcy Code that deals with the bankruptcy of a securities firm called SIPC. We have a different set of provisions dealing with the bankruptcy of a commodity firm, and it's called segregation, and the rules and specific behind provisions, I should say, under the Bankruptcy Code, all of which are designed to protect the client assets against the claims of creditors of the bankrupt firm. So our regime is pretty good. But now that you're considering portfolio margining, you're considering OTC clearing, there is no concepts of swap dealers in those codes. There is no and the issue that we deal with in the U.S., and it varies even between securities and futures, is a concept called specifically identifiable property. How do you treat assets of a bankrupt estate that belong to a particular individual versus cash? And with futures margin and with OTC clearing, with cash being a principal player, you got to be very careful, and you got to address these issues just to make sure customer assets are protected down the road. Now let's go across the ocean. Monday morning, as I said, all four of these Lehman affiliates, as well as many others, file for bankruptcy in their respective countries. So I'm going to focus mainly on LBIE, meaning Lehman London, but the issues that happen in London also exist as we speak in Japan and Hong Kong, Singapore, and everywhere else. Monday morning, the UK government appoints, as you know, PricewaterhouseCoopers as the administrator, and the administrator is very similar to the concept of bankruptcy, a trustee in bankruptcy that we have here. And PwC comes in Monday and really doesn't allow any transactions, transfers, or even positions liquidations to occur. Tuesday, they do not allow any transfers or position liquidations to occur. By Wednesday afternoon, through a lot of pressure put on by the PwC through a lot of other entities, they finally allowed positions to either be liquidated or transfers to other firms. Now, I want to give some special credit right now to LCH ClearNet. I know Roger's going to be talking in a second. I want to give special credit to Andreas Preuss at Eurex Clearing. Those two clearinghouses stepped up to the plate and really helped what happened on Thursday and Friday of that week. On Thursday and Friday, every customer position held at LBIE got transferred to other firms. I mean, to me, in a 2-day period, it was a miraculous transfer, but by the close of business on Friday, September the 19th, no Lehman entity held any customer position. That's the great news. The bad news is not $1 has been transferred out of the bankruptcy estate in the past 15 months. Margin, as we all know, are used to provide risk protections to the clearing firms, and when the positions are liquidated or transferred and there's no longer a need for margin, there's no longer a need for the clearing member to hold that cash or collateral for margin. By September the 19th, with all of the positions around the world transferred out, there's no longer a need for the margins to be held by any of the bankrupt estates, but because outside the U.S., in at same pot that the futures margin was held, you have securities margin, you have OTC swap margin or cash or collateral, and when you have the one pot approach issue, they're not going to allow the monies that are held that were strictly for futures to be released until they resolve the entire pot. And that's one of the issues that I hope that this committee and the commission through IOSCO or whatever, how do we address the bankruptcy provisions globally? Bring them up to some level where clients of a bankrupt estate do receive the necessary protections, and not only to protection of the assets, but the rights to get the assets distributed if the risks are no longer associated. The products are no longer on the books of the bankrupt estate and no longer the need for margin. How do we get margins or client cash or collateral transferred out of the estate and back into the hands of the customers or their new clearing firms? So it was a lesson that I think was learned post-Lehman. I think if you asked me that question before September the 15th, I would have said, of course the margins would have been transferred out, but I was wrong. Yes, sir.
I clearly know a lot less about this subject than you do. But I didn't follow. Your U.S. company, by Friday, everything had been moved out. And I thought you were saying is the London company, this LBIE, though it was a different process by that Friday, also everything, because you gave a compliment to Roger and Andre.
Positions were moved, but not the underlying cash or collateral that was used to margin those positions.
Oh, I see. So
the margin, client assets.
The margin that was there in September of 2008
still sits there today.
Still sits there. The counterparty might have had the trade move, but then they had to have a lot of lawyers chase after the margin.
Well, if you think about it, the client base were a lot of large U.S. mutual funds and pension plans who had a global trading strategy. I mean, they were trading equities globally, and they used the stock index futures outside the U.S. as a hedge. Those positions.
I think I understand that. So in the U.S., the position and the margin moved.
Correct.
By Friday.
Well, the margin with a little bit of a glitch, but yes.
It's a glitch, but by Friday it moved, right? That J.P. Morgan.
Well, it was about a week later the margin got, but it got moved.
But in the Europe, the positions were moved, but not the margin.
Correct. A couple exchanges around the world chose not to allow the transfers. They were smaller amounts. They were not significant to our client base, but a couple smaller exchanges chose to liquidate and not allow the transfers to occur. So those are probably the exceptions on the positions, or the open positions. But as you're going to hear probably today from other speakers, the issues outside the U.S. are not just future-centric. It's because of the one-pot approach for all products. You have that issue that needs to be addressed and try to figure out what reforms, either legislative or regulatory, are needed to provide greater protections to customers, because it is a global market.
Ron, in the jurisdictions where positions were liquidated, what happened to the release of margin in connection with those positions?
No difference.
No difference.
No,
it was
because
all held
it was.
Yeah.
Those are both European exchanges, Bonnie, and LBIE had a customer omnibus account,
right?
And they still, to my knowledge, they're still holding them, and they may have been returned to PwC. I don't know the answer to that, to your question. Same thing happened with LCH and Eurek. We had a lot of client margins, obviously the place with the clearinghouses to clear those positions. I really haven't stayed with the issue of what happened. Did PwC collect those assets and still holding those assets? The one thing I have heard, and I was, by the way, I was not at Lehman at the time. They invited me back that week to come help. So I want to make that straight. I was in academia land, and by the way, academic land is great. I haven't followed what happened to the monies, what happened with the PwC. So at LCH, they had a bunch of client assets because Lehman was clearing. When the positions got moved, did they give it to PwC? And the one thing I have heard, and I can't verify this, is that the assets around the world are still protected, still being held. It just haven't been released. So that's the key part of the issue.
Actually,
hey, Ron,
Roger may
Jim,
be...
one question. On the exchanges that forced liquidation, how quick was the liquidation period, and how damaging was that to the customers?
Thank you, Jim. I think they happened on that Wednesday of that week. I mean, I was brought back, as I mentioned, I was on the phone call with those officials at those exchanges, pleading with them from a public interest, public policy perspective that it's not in your interest to liquidate, it's in your interest, and we had a home for those. So why not transfer them, let's say, to a Goldman Sachs that night? They're no longer on the books of LBIE. They'll be on the books of Goldman Sachs at that particular exchange, but they just chose to liquidate. Now, the good news is it was a very small portion of the total pot.
Eric, do you have a
Ron,
question?
sorry. When the LBIE positions moved without the money, did the new clearing firms require the margin to be deposited before they would accept?
No, I think, well, as in any ex-pit transfer, you take the positions and expect the margins to come the next day. Given the fact that a lot of the clients were, very premier U.S. clients, what happened to those clients had to put up extra margin at the new clearing firms just to margin these positions that came on that Thursday and Friday of that week.
Ron, I assume there have been bankruptcies before Lehman of other broker-dealers in the UK, whether it's Barings or I don't know of any others, but why do you think there was a lack of clarity in this case? Was it something unique to this situation, or was it, do you think there was a lack of diligence on the part of various market participants about how this regime worked?
Sorry, thank you, George. I don't have the exact answer to your question. And I think you have to look at Lehman, and you also have to look at the UK bankruptcy laws. They have a unique approach to much different than what we have here in the U.S. Their approach is, if you're the administrator, PwC, and you release the funds, as it turns out, that transfer or distribution of those funds turns out to be an incorrect one, you're personally liable. And they are fighting, as you may know, or trying to wrestle with the courts over there to allow a lot of the assets to be distributed. And to date, the courts have not authorized those transfers. And there's a quirk over there in their UK bankruptcy laws that, to me, needs to be addressed and fixed. We don't have that issue here, but it does exist there. I think that issue, as much as anything else, has held up the transfer and distribution of the asset. That's my personal opinion, but I haven't been dealing with that on a personal level in over a year.
This is somewhat anecdotal, but I think that to some extent, as the complexity of cross-margining and cross-lien relationships and looking at single pools of money to support multiple products and multiple transactions, the possibility of moving pots of money that are sort of clean and neat gets harder. And so if you're a trustee in bankruptcy and you're very worried about the fact that you could be liable for supporting one group of creditors versus another, you're at much more risk if those cross-collateralization arrangements exist, which of course is something that we all need to think about as we talk about portfolio margining and multiple asset classes sitting in a single pool of customer funds.
But Bonnie, let me just raise a little slightly different issue with futures. We are talking about let's take LBI. LBI had a customer omnibus account with LBIE, and the only positions in that one account, which is the name of LBI on the books of LBIE, were futures positions. Let's say, hypothetically, the margin requirements were $100 million. I don't know the number. When the positions were moved out by Friday, September the 19th, you can identify that that $100 million belongs to LBI and the customers of LBI, and I am still uncertain and surprised why, because they've been able to identify that, they haven't released it. Now, I think the answer is because it's the one-pot approach, and if the swaps or other products had a shortfall, everyone has to be treated on a pro rata basis. So I can't distribute 100 because it may be a 10% shortfall or 20% shortfall or some other amount. Then why haven't they even distributed 50 or 60% or some other number back to the Lehman clients issue? That's the one part I have not heard a proper answer for.
think at this point we'll turn to Bob Wasserman to give, oh, sure. Commissioner Dunn has a question.
Just a quick question, Bob, because I thought your paper was excellent, and your recommendation and 13 recommendations that you had in there of what we ought to be doing is very important. But number 12 on your recommendations that comes to the tip of your tongue, I'm sure, is to put together a task force to come up with some best practices. And frankly, I was dismayed that we here at the CFTC did not have a contingency plan available. Fortunately, we have some very dedicated employees like Bob Wasserman, who was on vacation at the time, was working from truck stops, calling us, telling us, here's what you've got to do and here's how we establish it. But that appears to me as something that could be done immediately in concert with our regulator brotherhood to think about these best practices, and at least in the future side, establish some of those now and have these contingency plans so that you're not called back from academia the next time there's such a...
Well, a couple comments, Mike. First of all, then acting Walt Lucan, his staff, Ananda, and his staff were fantastic that week in September. I mean, I was on the phone with them 2, 3, 4 times a day, bringing information to them, alerting them about current status, as well as seeking their assistance on a number of issues. So I want to commend not only Chairman Lucan's staff, but the staff of DCIO. They were fantastic that week. But the reason I think the task force and why I recommended it, I was on the Bearings task force, what was it, 95 or 96, and Bearings alerted us to a very important and large problem that existed, and I thought that task force really brought together not many people of different types within the global industry, and it came out with a lot of reforms that followed that task force. I thought, if you ever read the task force report, I think it was one of the better reports this industry ever did. And I think the same type of study, review, analysis should also be considered in connection with this issue.
Bob, if you would, please walk us through from DCIO and from the CFTC's perspective.
So I'm going to do ultimately 3 things. One of them is to discuss our perspective on what happened in Lehman. The second is to talk about actually an IOSCO project that we're currently leading in terms of understanding and bringing, frankly, out to the world an understanding of what both customer protection regimes and insolvency regimes for investment firms look like. And finally, talking about some of the things that we're doing now. I'm going to do those first 2 of those now, and then the third after Roger Liddell has had a chance to speak. If we could put the PowerPoint up, or... Thanks. So, very briefly, in terms of our perspective as to what happened during the Lehman insolvency, basically, the protection of LBI's futures customers worked. They were transferred to Barclays not quite on Friday. Actually, we had to wait until the bankruptcy court approval, which happened at about 1:15 a.m. Saturday morning. And then the process happened happily over the weekend, so that by the time the markets were open on Sunday, customers who had been at Lehman were transferred to Barclays. And with minor exceptions, and Ron alluded to that with some of the issues with, well, customer funds, customers did not lose control of their positions or their property. And so, in other words, again, subject to those minor exceptions, at all times, futures customers for LBI had control. Protection in other jurisdictions worked somewhat less promptly and effectively. And in most jurisdictions, that process is ongoing. And in many of them, it is unclear that all futures and securities customers will recover the value of all customer property. I'd like to talk a little bit about, from my perspective, what the requirements that we have that contributed to the success of our model. First is that The Act, Section 4D, and our regulations require that all customer property be segregated at all times, that no liens on customer property are permitted, and that while we do under 125 have certain arrangements for hypothecation of investments, the full balance, and thus the proceeds from that hypothecation, are required to be in segregation. Our bankruptcy code and the Commission's regulations in Part 190 encourage transfers, and those transfers are protected against avoidance under the Bankruptcy Code 764B. There are also some circumstances, some factual issues that contributed to our success. Lehman chose to compute their Part 30 secured amount in a manner consistent with 4D. That is to say, they chose to require that all foreign futures customers, all of their customers who they were clearing positions for on non-U.S. exchanges, they had their funds and property segregated as part of that secured amount, and they did all customer property rather than the minimum requirement, which would be required margin plus accruals. We're also lucky that there was no shortfall in customer property. A number of you will remember Griffin Trading, where there was, and things did not work quite as efficiently. And the fact of the matter is that if you have a book of business with no shortfall in customer property, that's valuable. Somebody's going to want to buy that. Indeed, I mean, in this case, there was a transfer that included real estate and for some $1 billion, although I think the value of the book was not that quite so much. In Refco, a couple of years ago, the transfer of the book brought into that estate $200 million, just simply the privilege of having that book. I'd like to talk a little bit about an insolvency project that CFTC has been leading at IOSCO. And this is within Standing Committee 3 on intermediaries, and the purpose is to summarize the regimes for protection of customer property for futures and securities customers in major jurisdictions. And that we have first designed a survey to look at protection of customer property both pre-insolvency and as part of the insolvency regime. And I guess one of the important points here is that I think prior to Lehman, a lot of folks were thinking, okay, here are the rules for the protection of customer property, and we're going to segregate it, and we're going to follow those rules and make sure people are following that, and everyone will live happily ever after. Without thinking, well, that's nice, but how does that work in practice when the insolvency comes? And so it's not enough to look how things work in the ordinary course, but then practically, will it work? And this survey covers both periods. We've received preliminary answers to the survey, and we're going to be working with other jurisdictions to clarify those answers, to summarize and compare the results, and with the approval of the technical committee, to publish the responses and a summary of those responses, and if practicable, arrive at common principles. And because, of course, this is an organization that works, frankly, primarily by consensus, it may or may not be practicable to come to a consensus as to, at least within this organization, as to what principles there should be. However, I think we're fairly comfortable that simply providing these answers is going to advance the ball significantly.
Bob, what is the time frame for the survey to be complete and potential recommendations or practical solutions?
Hopefully within the next 6 months. And as I said, we've gotten back preliminary answers. I think staff here are going to be working sort of bilaterally with the other jurisdictions to clarify those answers. And we basically are intending by our meeting in April to essentially be able to hopefully finalize that. That may or may not be practicable. I'd like to talk, however, about preliminary results. Because they are preliminary, I'm not going, in general, not going to be too specific with regards to who said what in this survey. First, let's talk about segregation. Some jurisdictions require segregation on a customer-by-customer basis. That is, each individual customer has their own separate pot and therefore is not exposed to their fellow customers. That protects against fellow customer risk, but there is, to be sure, some cost and efficiency. Some jurisdictions permit customer property to be topped up promptly after a periodic reconciliation. So in other words, you do a reconciliation, say weekly, and if you find out that you don't have enough, you have until the next day to put the money in. Well, that's great. It certainly is better than not doing that, but if an insolvency occurs before the reconciliation or before you've topped up, you've exposed yourself to a shortfall. Debit balances. Some jurisdictions permit a debit balance in one customer's account to offset a credit in other customer accounts. And for instance, the 3-3 calculation for securities. However, that of course leaves recovery dependent on collection from the customers with the debit balances. And it may make transfer less practical. Firm property as a buffer. Our regime permits, and de facto I think strongly encourages, a buffer of firm property in the customer account. We require daily reconciliations. If at any time when you do this daily reconciliation you realize that you don't have enough money, you do the reconciliation by noon as of close of business the previous day. If you find that you were undersegregated, you have to report what is a violation. As a practical matter, the more often than not, it will be some sort of innocent error, and what will happen is your self-regulatory organization will be paying special attention to you and make you, write it on the blackboard. You won't do it again. But essentially, it is a violation, and therefore, people want to avoid that. They put extra money in, which in the event of insolvency is therefore available. Or in the event of a large customer loss, again, the money is already there, and so therefore there's that additional measure of protection. Some other jurisdictions permit such buffers. Some jurisdictions actually prohibit leaving firm funds in the customer account. And specifically, there's a concern, the UK is one of these, that there would be possible damage to the trust status. That essentially, if it's supposed to be a trust for customer funds, then you can only have customer funds in there. Again, the downside of that is there's less money available if and when something bad does happen. Liens and rehypothecation. Some jurisdictions allow liens on customer property with permission of the customer, and some allow the firms to rehypothecate customer property. Well, when you think about it, property that's been subject to a lien or has been rehypothecated may not be available in case of the firm insolvency. In fact, it likely won't be. And I think, frankly, in the case of the UK, a lot of the difficulties that they have are tied up in that permission, that you have customers who granted permission to have their assets rehypothecated, which essentially undercuts the protection of those assets. And so if you've granted a right to use your property, it may not be there for you when you need it. That is the issue. Those are the issues pre-insolvency. Let's talk about what happens in the context of the insolvency. Some jurisdictions permit the futures or securities regulator control or influence over the selection of a trustee, administrator, or similar officer. In our context, what happens is we've been in contact with the U.S. trustee, who tends to select trustees in the case of bankruptcies in Chapter 7, or we were in contact with our colleagues at SIPC in the case of a BDFCM bankruptcy in a SIPA proceeding. And so essentially there is a greater likelihood of having a trustee and or an attorney for the trustee who's familiar with the industry, who understands what's going on, because if you come in there without that understanding, there's a steep learning curve and almost no time to get up that learning curve. Some jurisdictions provide specific guidance for the trustee, and for instance, our Part 190 is pretty much a cookbook as to what it is they're supposed to be doing. Others do not, and as I say, a customer who's unfamiliar with the industry, taking charge in volatile markets, acting without instruction from a regulator, can cause some difficulties. Transferring customers. As I said, our rules and statute encourage the trustee to transfer customer property and positions to a solvent firm if practicable. Now, as I mentioned before, the practicability in large part depends upon, is the customer property there? If the customer property isn't there, transfer is going to be a lot less practical. But we've had, in the past couple of years, a number of very large insolvencies, Refco and Lehman, where the customer property was there, and that instruction to transfer, that guidance to transfer, I think has helped. And of course, transfer is ideal for transferred customers and arguably for the markets. But that efficiency may come at the expense of fairness to other creditors. And so I think folks in other jurisdictions view that, because essentially, for instance, we protect those transfers and the transferred property against any clawback. That may happen at the expense of other creditors. We've taken the decision, our Congress, that essentially that's to the good because it's important to protect the markets. But other jurisdictions can weigh that somewhat differently. As I said, protection against clawbacks. Compensation schemes. Many jurisdictions have compensation schemes to protect securities and futures customers against loss. But that protection, and from a retail perspective, is very significant. From an institutional perspective, perhaps not so much. For instance, SIPC's $500,000 limit is among the largest among the jurisdictions that reported. Most of them are closer to around $100,000. Allocation of losses. And this actually is important, and I think goes to some of the things Ron was talking about earlier in the UK. Some jurisdictions allocate the losses pro rata. We do, both on the futures end and on the securities end, except the securities end has the SIPC protection. And so essentially we can look at the customer property pot and say, okay, everyone's going to get 50 cents on the dollar or maybe more, but we've got enough to pay people a dividend, and so you can have dividends and get at least some of the money out. Some jurisdictions will allocate losses based on customer permissions. So those customers who said, well, you can use my collateral are going to be treated differently from those customers who said, no, you can't. Of course, once you have that permission out there, there's an immediate practical effect of you're going to need to pay some accountants a whole lot of money to untangle all of that and untangle the records and say, well, this customer gets treated this way because the records say this, and that one gets treated that way. There is an efficiency to treating everyone the same and mandating treating everyone the same, because you can then say, okay, everyone's treated the same. You don't have to worry each individual customer. Some jurisdictions allocate losses based on which property is missing, and the UK is among these. And so whereas for customer funds they would operate pro rata, with respect to customer property, they're going to allocate losses based on which property is missing. If one customer, or if one group of customers, in other words, the property they posted was IBM stock, and another group of customers posted Amazon stock, and it turns out that the IBM stock is almost all missing, Amazon stock is there, the first group of customers is going to be allocated more of the losses. So until you can untangle who owns what, then you can't do the distribution. And again, hanging over the trustee, of course, is the fact that, hey, if I distribute the wrong thing, I'm personally liable. Not only that, but the courts in the UK the trustees have been trying to urge them to allow even some means of having a scheme of distribution that would have some deadlines and saying, okay, you've got to make your claim by thus and such a time, or we're just going to distribute the money. And my understanding is that first the Queen's Bench and then or the Commercial Court rather, and most recently the Court of Appeal have essentially held, no, sorry, you can't do that. You've got to follow normal trust law, however complicated it might be. And the rest of it I will cover later.
Thank you, Bob. We have Roger Liddell from LCH, who is also going to speak on this subject from what happened from the Libby side and from LCH. Roger?
Thank you very much, Madam Chairman. I will be brief for two reasons. First of all, I think Ron did a great job of describing the general sort of activities and not just the US activities, so I won't repeat all of that. And secondly, I think it's probably more productive to leave time for some questions or discussion, which I think is the way this discussion seems to be going. But let me just add a little bit more colour and give you a little bit more specifics. I think what we experienced in the first hours and the first couple of days were some events that we hadn't anticipated and certainly hadn't experienced. I think some of those were, some of the specific differences in the bankruptcy regimes in different countries and the relative protections that they offer to customers and the relative difficulties they have. So the fact that they are different is an issue. The other related issue, though, is that in a large, fully integrated financial institution like Lehman Brothers, it's an integrated network, and to separate out regional pieces of activity and handle them in isolation, really doesn't work that well these days, which I think raises some much broader issues. There are issues around a single pot, which Bonnie referred to a bit earlier. They complicate things from a liquidation perspective, which can be a problem. It's also, frankly, a huge benefit alternatively. So for us, having a single pot of collateral covering a whole range of different asset classes meant that as we were able to liquidate some more quickly than others, the headroom that liberated was effectively usable to us to create more protection against some of the other asset classes. So there are pros and cons with that. But in terms of the specific events, the first issue, of course, was that we didn't have good access to data. But the reason that was important, actually, the primary reason that was important was because a high proportion of the futures clients of Lehman Brothers International Europe, a high proportion of them, and I think the number was probably around 60% by value, had opted out of segregation protection in the UK. Many of these were US customers. I think probably about 50% of them were US customers. Now, we were not explicitly aware of that because basically the activity that we had with Lehman Brothers International Europe was, to us, traditional futures clearing member activity. House account with a lot of positions in it, and a client omnibus account with a lot of positions in it. So as the events started to unfold, actually over the weekend, but then on the Monday morning, we started the process of identifying the risk in the house account to hedge it, and in identifying the client positions in order to transfer them. What became apparent within the first hour or so was that a lot of the positions in the house account were in fact clients. And we only realised this because we recognised some of the names. So then it became obvious that we couldn't hedge any of the house positions because we would be potentially hedging some of the client positions that needed to be transferred. So that created an immediate requirement for us to understand from the books and records of Lehman Brothers precisely which of those positions were in fact house accounts and which were client accounts. Just scanning down the list and looking at the names, it just isn't obvious because a lot of internal trading desks in big financial institutions look like small funds, look like hedge funds, West Coast commodities, desk and things like that. So we realised that we needed this information from Lehman Brothers and tried to get it. And that's when we ran into the problem that Ron referred to earlier, which was under the UK regime with the administrator and with the potential liabilities that they had individually, they were very nervous about giving even information away. So after an hour or two of trying to get information electronically, we actually sent people down physically to just go and get it. And that wasn't easy either. They were turned away. There were security guards preventing them getting in. We were threatened with police action because we were trying to get through the barriers and all that sort of stuff. So eventually, after a long time, our people managed to get access during the afternoon and started to sit at the terminals inside the Lehman offices, starting to print from screens client positions and so on and so forth. Meanwhile, and again, this is probably some of the more extreme, examples of the mismatch between the insolvency regime and the need to have an orderly liquidation of important client positions. Meanwhile, the administrators were sort of giving interviews on TV and whatever, saying, look, this is what's happening, explaining the process. And by the way, none of the staff that are here at Lehman Brothers are going to get paid. So all the people that we were working with to try and get all this information just sort of disappeared. So the next morning we went down to gain access again, managed to persuade all the staff that had gone home to come back and gave them contracts of employment to sort of hire them, and went in to try and get these positions to do the transfer on the Tuesday. By this stage, the lawyers had been in there, and I realise a high proportion of the people in that room are lawyers now, so I won't be disrespectful, but that wasn't a healthy step in the process. And the administrators were therefore very nervous about giving us access to data. So all of the terminals that had this information on had all of their ports blocked to prevent our people from being able to download information to bring back to our offices to use, which is really quite an incredible sort of state of affairs. Meanwhile, we had some screen prints the night before, so we knew exactly which reports we needed and where all the data was. And thankfully, we were able to speak to the folks in the New York office, Ron and some of his ex-colleagues, and say, look, we really need some help from you. Can you get these files for us and send them electronically? So while we were having big arguments with the lawyers and the administrators in London, we're actually working in a much more collaborative way with the staff in New York, who were able to transfer all these files to us with all the data that we needed in order to transfer customer positions. So that was great. Ron, I think you referred to the restrictions that the administrators placed on in terms of being willing to allow us permission to move assets. I mean, ultimately, actually, they were not. Actually, we could not get them to agree to allow us to move client futures positions, not the collateral, the futures positions. And they want us to sign all sorts of disclaimers that if that we'd move it back under certain circumstances, none of which was compatible with the futures market generally. So what actually happened was that because we had this information, the electronic information from the States, that we no longer needed the data from the UK, we chose not to require the permission from the administrators to move it. So we basically moved all the positions without the permission. Over a fairly concentrated period of time, and actually that introduced an awful lot more risk than would have been the case had we had access to the right information within the right sort of time frame. Now, this was obviously a huge problem and a huge source of frustration. Thankfully, it went okay in the end. This will require changes to the UK insolvency regime and the bankruptcy legislation, no doubt. In the short term, however, I'm confident that there has been a good level of understanding reached between the local regulators, the courts, and the primary insolvency practitioners, so that in the event that similar circumstances happen again, I'm confident we'd be allowed access to the data that we need and things would move much more quickly. But again, it was a combination of the lack of availability of data to us and the fact that a lot of clients had chosen, how obvious it was to them that they'd chosen or not, we don't really know, but they'd chosen to opt out of segregated protection, which meant that we had to treat the firm and the house collectively. I could go on a lot more, but I think I won't. I think it's probably best if I just close there and invite any questions.
I think we do have some questions for you, Roger.
Hi, Roger. It's good to see you again. I had a question. You were talking this through, but this was more broadly than just futures. Was this also futures and the swaps, or were you narrowly talking about just one book of business?
I was narrowly talking about just the futures. The same problem didn't occur in swaps at all or elsewhere.
Do you want to take, maybe it's 2 minutes, but tell us about how you transferred the swap book?
Yes, I will, and I'll try to avoid a commercial. I mean, the first thing is that the swap book only involved interbank activity. So we basically were sitting between the Lehman Brothers trades and each of their interbank counterparties. And I'll describe briefly how that happened, but that's the first thing. There were no customer positions that needed to be transferred. What this has meant, however, is that as we now are preparing to get involved with real customer business, we obviously are unhappy that this regime does not work well enough for real customers in OTC derivatives. So what we've actually put in place now for swaps in particular is a regime which allows us to actually bypass the administrator and to actually liquidate collateral in the omnibus account that the bank will have with us on behalf of its clients, and to sell that collateral and to move it to the incoming clearing member that's inheriting those positions, and to bypass this entire process, which, as Ron quite accurately described, has not yet unfrozen.
So you have an approach in the future to be able to deal with customer, or what some people here call end user clearing, by having the omnibus account or the collateral at LCH rather than over at the bank where the administrator might freeze it.
No, the accounts are still at the bank, but the omnibus account of all of the bank's clients is with us, as it is with futures. But what we've developed is a regime that would allow us to sell the collateral in it and to allocate it proportionally to all the clients. That hasn't changed the situation with regard to the futures activity. That remains the way it is today. So we haven't solved the futures problem, but we have actually made provision for the OTC derivative markets. But the way the swap default actually was handled was that basically, because there's no means of us liquidating it over exchanges, we instituted the default management process that had been sort of developed over the years, which really entailed us calling in nominated individuals that had been pre-assigned by 5 of the main 12 swaps dealers to come in and trade under our instruction and on our behalf in order to liquidate the portfolio, which is what happened.
Does anybody else have any questions for Roger at this point? Ron?
Jill, I want to clarify one little point that Roger just mentioned, and at least this was the situation when I was there, and things might have changed, but we did not have any U.S. futures have a direct account with LBIE. Every U.S. base futures account had an account with LBI, and an LBI had an omnibus with LBIE. I think what Roger is referring to when he said several U.S. clients, quoted, opted out, was our offshore hedge funds, whose money managers were based here in the States, but the entities themselves were offshore. They were doing their OTC equity derivatives with London, and if they're doing the OTC equities derivatives, they were doing their futures as well. So I don't, in my mind, even though the money managers are based here, the funds being offshore, I never looked at them as, quote, a U.S. account. In fact, if any client ever asked me, do you allow us to opt out, it was no way. I'm just not an opting out person. So to my best of my knowledge, unless things changed, no U.S. person opted out, but some of our offshore hedge funds, because of the capital and the way you play the game over in London, was a lot cheaper than you could play it here. A lot of the offshore hedge funds did have direct accounts, and so if they could do the OTC in London, might as well do the futures and all the other products there.
Don?
Yeah, Roger, this is Don Wilson from DRW. It's my understanding that LCH's new swap clear structure really only offers clearing for its dealer members. In other words, large users of the market and even major liquidity providers who currently operate exclusively in centrally cleared markets will not have the option of clearing their trades, but will instead face their chosen prime broker in traditional bilateral arrangements. And although LCH has attempted to mitigate some of the risks traditionally associated with bilateral trades, the trades nonetheless remain bilateral. So it's not really a central counterparty. It's merely a clearing between dealers. And the other just flaw that I see in LCH's new proposed swap clearing model is that by virtue of this structure, users of the market will only be permitted to trade with LCH dealer members. In other words, the market in interest rate swaps will not receive the benefit of the liquidity provided by non-bank liquidity providers. And rather than taking the opportunity to reduce the reliance on, too big to fail banks, and the LCH's model instead perpetuates this structure, and so I just, you can correct me if anything that I've said is wrong, but I wanted to highlight those concerns because I don't think that structure is in the best interest of the marketplace.
Okay, well, I mean, essentially, the situation is similar, or it's the same as the futures markets, which is that we have direct clearing members. We don't care who anybody trades with; they can trade with anybody they want, as long as they clear through a clearing member. So as long as both parties to a transaction each have a clearing member to clear on their behalf, then that's fine. We can clear any trade that comes from anywhere. It doesn't matter.
So you're saying that one customer of the market could trade directly with another customer of the market as long as both of those trades, as long as both of those customers cleared their trades through an LCH swap clearing member.
Yeah, absolutely.
But I think Roger's point is, will you allow non-dealers to become clearing members? Will you have open access to clearing members as we've proposed in our regulatory regime in front of Congress, that the clearinghouses allow non-swap dealers to be clearing members?
Yeah, I mean, there are criteria that need to be met in order to become a clearing member. The criteria do not include the type of institution that any particular firm is. They do, however, include their regulatory status, their level of capital, and also the size of the swap portfolio that they have. And the reason for that is that ultimately, in a default situation, we, the clearinghouse, don't have the ability to just go out and close out across an exchange, and need to have a complicated hedging mechanism where the banks within the service effectively mutualize that risk amongst themselves. So all of the firms that need to participate in that process need to have access to a lot of liquidity and need to have the capability internally of having a big portfolio. So the rules are fairly onerous and stringent, but they don't determine the type of organization that can become a member.
Could a non-dealer realistically meet those, or are they so written that it'd be just the dealers are going to be the only members?
It would be very difficult, frankly. It needs to be a regulated entity, and the size of the portfolio needs to be at least $1 trillion. These are rules that have been in place for 10 years.
Yeah, just to repeat what I've probably said, I think that swap clearing is very important. It helps lower risk, but I think it best benefits markets if it's opened up more than what you've just probably described.
Just to touch on the first point that I made, I mean, is my understanding incorrect that the trades that the customers make are technically not cleared trades, and they're still bilateral trades, even though there is a kind of a centrally cleared element to the component that's between the dealers related to those trades?
I'm not sure I understand the question fully, but again, two counterparties, whoever they are, can transact, and as long as the transactions are submitted via two clearing members, or even the same clearing member, then they'll come through the system. And we'll be subject to the same protection and the same margin regime as all of the transactions.
Tom, did you have a question?
Now, again, on the books of the clearing member that has those transactions, effectively they'll have a back-to-back, one with us and one with their member. But the protection that that client will get will be exactly what I described before, which will be the portability of initial margin and the ability to transfer a position outside of the regime of the defaulting member.
Yeah, I guess that's my point, is that it is a back-to-back trade. It's a bilateral trade between the customer and the clearing dealer, and then, yes, then the other side of the trade is with the clearinghouse. But I mean, for instance, if a customer of a dealer who clears, let's say, J.P. Morgan, calls up Goldman Sachs to transact a swap, then they can transact the swap with Goldman Sachs. The result of that trade will actually be a cleared trade between Goldman Sachs and LCH, another cleared trade between LCH and JP Morgan, and a bilateral trade between the customer and JP Morgan.
Yeah, but the key element is that this is a sort of a one-way protection, right? So effectively the process protects the clearinghouse and the clearing system and the rest of its members from the risk of a defaulting member. So that from the the clearing member bears the risk of its own customer, whereas the customer of that clearing member doesn't bear the risk of its clearing member. In other words, if the clearing member goes under, then we bypass the clearing member and access and move the initial margin and the variation margin of the end customer to an incoming clearing member.
Right, as long as
kind of
an
one way.
clearing member agrees to take those trades. So I think it's important to point out it is a bilateral trade. However, you've put some clever mechanisms in place to hopefully lower the risk in the event that the clearing member files for bankruptcy.
Yeah, I mean, the only issue is the one I think you alluded to, which is that if there's no clearing member willing to take on those positions, then there's nowhere for those positions to go, in which case that position has to be liquidated.
If I can ask Roger what I hope is a clarifying question. I've been involved in a lot of discussions, as have many people, about the differences between clearing on an agency basis and clearing on a principal basis. But I guess the fundamental question is the legal model that LCH has established for clearing non-clearing member swaps significantly different than the legal model that LCH believes exists for clearing futures contracts?
Well, I mean, I guess it depends where, because futures contracts are different in different locations around the world. But broadly speaking, I think it's similar. I think from a client perspective, the regime goes well beyond what exists in most futures markets around the world, particularly in Europe.
Tom.
Roger, it's Tom Callahan. We've discussed in some detail in this meeting of the potential complications that arise out of cross-margining and cross-lien arrangements in the event of a client or member firm default. But you also said in your introductory comments that there's another side of the story, that in a default scenario there's a benefit to seeing essentially the whole of a defaulting member's position. So I was wondering if you could just elaborate on that a little bit further in the context of what I believe was a $9 trillion liquidation that LCH managed without touching any default or guarantee funds, which is a remarkable achievement. But was portfolio margining a factor in that successful liquidation?
Well, ironically, the $9 trillion was the size of the swap portfolio, and in Lehman Brothers' case, they actually used a different entity for that to all of the rest of the activity. So everything else they did with us was in one entity, and the swap portfolio was in a different one. So there was no benefit in that particular case to us of the portfolio effect. With the rest, though, there was, and that made a significant difference. But I think, as we talk more about cross-product margining, then effectively the benefit that we were able to enjoy outside of the swap portfolio arguably moves away from the clearinghouse and towards the client once you offer more comprehensive cross-product margining, which is why I think that we need to be particularly thoughtful as to how we eventually do that. And the issue, I think, really, frankly, is less to do with cross-product margining and more to do with cross-product default management, because it's easy when you can take individual portfolios and liquidate them separately. But if you're allowing cross-product margining and giving relief because of natural offsets, then you have to have a much more integrated, organized liquidation process, and that's the sort of stuff that we're looking at now.
Thank you. We are running just a little bit behind schedule, so I think what I might suggest at this point is Bob had a few more slides left on what the CFTC staff has proposed of the CFTC's efforts with regard to these kind of issues going forward, and a sort of lessons learned on these issues. You all have these in your packet, so if you have any further questions on these particular issues, you can let us know at a later time. We are going to take about a 10-minute break and come right back to start discussing the U.S. and EU OTC derivatives proposals. Thank you, Ron. Thank you so much, Roger and Bob, for participating in this discussion. Thank you. If everybody can take their seats, I'm going to go ahead and get started with the second part of the meeting. We're going to go ahead and get started if everybody can take their seats. As I mentioned in my opening comments, the CFTC is very honored to have with us our colleagues from the European Commission here today. This is a very challenging time for market regulators, and more important than ever, really, for us to be coordinating with our counterparts in Europe. And we are so pleased to have David Wright here with us today to talk about these issues. Patrick Pearson is also to his right at the table, will be participating in the discussion. And I'm going to go ahead and start with David and to let him give an overview of the communication that the EC put out in October and maybe, David, if you could go over the timetable with us to give us an idea of where Europe is headed. Thank you.
Commissioner Summers, Chairman Gensler, Commissioners of the CFTC, thank you very much indeed for inviting us from the European Commission to this Global Markets Advisory Committee. We have worked very closely with the CFTC over many years, and we very greatly value our close relations, and we very much welcome all our contacts with Jackie Mesa and your staffs. And we were very honored, as Gary said earlier, to have him over and explain in considerable detail your policy, the U.S. administration's policy on OTC derivatives in a public hearing we had in Brussels, Belgium, earlier this year in September. And I'm here today not just as a genteel act of reciprocity, but also because we in the European Commission, the organization in Europe that proposes European law in the European Union, we believe very strongly that on this subject of OTC derivatives, and indeed on many others, it is absolutely essential that we have a common view and convergent policy outcomes between the United States and the European Union. That indeed is the spirit of the G20 with which we concur. As we all know, the US and the EU have by far the biggest capital markets in the world. By some measures, we believe in the European Union we could be bigger than the United States, but of course that's not the point. For derivatives, almost all the trading, major trading, is carried out in our jurisdictions. We have, of course, very different policy processes. We have different timing and sequencing, and I will say something about that. We have different political forces. You have your Congress, and we have our member states and the European Parliament who decide. But jointly we must, I believe, work very closely together to assure our common goals and objectives. And this won't be easy, but as I said, I think it's essential. If we do not do this, if our policy outcomes on derivatives show very wide variance, the result will be very simple. It's going to be regulatory arbitrage, unacceptable prudential risk, even the seeds for future financial trouble. We can't afford this, and we shouldn't accept it. This financial crisis will result this year in the European Union of a loss of 4% of GDP, growing unemployment, and a burgeoning public sector deficit, which in the European Union as a whole means that our public sector deficit will have grown by 20% of GDP in 3 years. And the same, I believe, same magnitude of destruction has happened here in the United States as well. So the system has got to be repaired, and we need, on this issue, more than ever, two mechanics, the United States and the European Union, acting together, acting as one. Already, ladies and gentlemen, there are strong signs that some would like to divide us on these issues. I'm quoting from the Financial Times of the 2nd of December. Headline, Europe and US split over the reform of derivatives. Some of our companies apparently are accusing you of being unwilling to relax the proposed reforms, referring to the issue, of course, whether to exempt end users from the reforms. And somebody is quoted as saying, well, if that results in divergence between the EU and the US, so be it. So the warning signs for both of us are there, and we better take care that we can avoid that. Let me briefly set out the goals we have with our forthcoming OTC derivatives reform package, the timing as far as I know it, and let's focus on some of the difficult issues where our convergence will be most tested. Now, we made a major policy statement on derivatives on October the 20th. This document has been distributed to you in your package here. It forms part of a policy process which will result in us proposing legislation in next year. And I can tell you that our President Barroso, confirmed now for a further 5 years as President of the Commission, has made it very clear in his testimony to Parliament that this Commission, his new Commission, will propose an ambitious initiative next year. Our starting point is exactly the same as yours, and I'd like to quote Chairman Gensler's testimony before the House Committee on Energy and Commerce Subcommittee on Energy and the Environment on December the 2nd. So you can see here we look very carefully and we follow all your comments.
I'm very honored.
You said, Chairman, though there are certainly many causes of this crisis, I think most would agree that the unregulated OTC derivatives marketplace played a crucial role. We fully agree. We believe these markets exacerbated the crisis, the leverage levels, interconnectedness, lack of transparency catalyzed this deep financial crisis and, frankly speaking, I believe very nearly decapitated the whole of the financial system. Credit derivatives did not disperse risk, they concentrated risk and concealed it. Now, let's look at what we are planning to do. And let me say here that we have a change of administration coming, as I told you. We have a new commissioner for the internal market and financial services who will take office, if all goes well, on the 1st of February next year. That is Michel Barnier from France. But we have a strong presumption that the policy I'm about to outline to you will form the core of our thinking in the months ahead. First of all, in terms of general considerations, we are talking about a paradigm shift. We're not going to tinker around the margins while Rome burns. We want a comprehensive policy. We want strong international cooperation, and we will include the non-financial part of the industry. The first part of our policy is to reduce counterparty risk. We will propose legislation to ensure that CCPs are safe and sound, with common safety, regulatory and operational standards. We will propose to improve the collateralization of bilaterally cleared contracts, both in terms of initial margin and variation margin. We will propose to raise significantly capital charges for bilaterally cleared as compared with CCP cleared transactions. And we will propose mandating CCP clearing for so-called standardized contracts. The second strand of our policy is to reduce what we call operational risk. And by that I mean we want to encourage further collective action by the industry to promote standardization of the legal terms of contracts and of contract processing. We want also to assess the need to reshape operational risk in the Capital Requirements Directive, the translation of the Basel process, in order to prompt standardization of contracts and electronic processing. Now, I can tell you we're going to use the pig iron if necessary, and we're going to set very tough deadlines for industry action. The third strand of our policy concerns improving transparency. What does that mean? It means mandating the reporting of positions and all transactions to trade repositories. It means proposing legislation on trade repositories and the supervision of them. It means mandating trading of standardized derivatives on organized trading venues, and it requires improving and increasing pre- and post-trade transparency as part of the upcoming review of our Investment Services Directive, so-called MiFID today. And this is for all derivatives markets, including commodity derivatives. The fourth part of our policy is to strengthen market integrity and oversight. What do I mean? I mean curbing insider dealing and market manipulation by extending our market abuse laws. We will, I believe, also in the future look at ratcheting up collectively in the European Union the overall level of sanctions. We must also give regulators the possibility to set position limits to counter disproportionate price movements and concentrations of speculative positions. So that is the basic approach, basic building blocks of our policy. Now, in terms of timing, first of all, we have to do something which we believe is very important as we prepare our final proposals. We have to carry out obligatorily an impact analysis, and that means before we make our formal proposals, we have to look in great detail at whether those strands of those policies that I've been outlining are the right ones. We have to look at the economics of the benefits and the costs, and we have to make judgments about some of this fine detail that will form the final part of our proposal. We try to do our work in a very open way, and I'm a big believer that the more open and transparent the policy process, the better it gets. And so our intention, and we have to see now according to the new Commission, which takes office again on the 1st of February, but our intention would be to start testing some legal texts early next year with our member states and, of course, with the industry, and we will certainly be seeking views from the United States and, indeed, particularly from the CFTC. Thereafter, around the middle of next year, we hope to finalize the first part of our legal text, which will basically cover the CCP issues and the trade repository issues. That's part one. Final proposals, we hope, by around the middle of next year. Thereafter, we will bring forward the amendments on the capital requirements side and on the investment services side towards the end of next year. So we're going to do this in two parts. That is the best timing I can give you today. I hope that will be confirmed. The President, as I said, has made it perfectly clear that this is top priority for his new Commission. Let me now raise, if I may, ladies and gentlemen, some of the difficult issues that it seems to us still need to be discussed and indeed resolved. And some of them we know, having been here for 24 hours, and 24 hours is always a long time in Washington, but we know a lot of these issues are already being actively discussed. The first issue I want to raise with you is the following, and that is the issue of scope. We favor, as I said, a comprehensive approach, inter alia, to avoid regulatory arbitrage. We do not favor exclusions for specific segments of the market, some of the forex markets, for example. We think CCP per se is desirable, and we believe the burden of proof is on those who believe that a segment X or Y should be excluded. Why should they be excluded? And frankly speaking, we have not heard any convincing arguments of why one part of this market should be included and other parts should not. So we like the idea of a comprehensive approach. Let me now say a few words on the big issue. This is a big issue here, and certainly will be and is already in Europe, which is the so-called end-user issue. Now, this issue has come quite late, in a sense, to the debate. We are on the record in our 20th of October communication. We have said the following, and I'm quoting, "The costs of strengthening OTC derivatives markets should not be carried by the taxpayer, but by those who directly enjoy the economic benefit of using derivatives. Some of it can be expected to fall on non-financial institutions." In other words, what we're saying is that there's been a general underpricing of risk in these markets, and so the burden has to be shared to a degree by everybody. We've said that we're going to carry out a full impact analysis on how we allocate these charges. We recognize that most, and I'm quoting here, most non-financial institutions are not of systemic importance. And we will strive to ensure that in our response, we make sure that non-financial institutions who use these markets to hedge their risks will be able to continue to do so. There is no intention to close off markets or close off participants in those markets. But what is clear here is that we are not going to try, we will not accept a policy which is full of the holes of an Emmental cheese. We do want to make sure that we have a consistent approach across all segments. So we don't have any firm positions yet. Some of the questions were going to be very important that we have to answer is how to separate the end users that are purely managing risk from those who are managing speculative positions. How do we avoid another Metallgesellschaft in Europe? How do we avoid regulatory arbitrage allowing financial firms to shift their risks into the unregulated area of oversight? And in other words, we want to avoid the build-up here of another new shadow financial system. And how do we achieve this same objective in the United States and Europe? Because we're going to have we have different legal instruments, and at the moment we have different legal definitions, and your definition of the major swap participants, the MSPs, is going to be very important in shaping that argument. The third issue which preoccupies us in a technical sense is the future role of the CCPs. We fully share the view that it should be mandatory to clear so-called standardized, clearable derivatives through CCPs. Indeed, the G20 has fully agreed that. But who is going to decide on what is so-called standardized or clearable? The regulators, the CCPs, both? How? Should the CCP not be able to decide whether it thinks product X or Y could be cleared safely? In other words, CCPs might not be directed to clear products if they feel they are unsuitable to be cleared. I think we feel at this stage the decision on whether a contract accepted for clearing by a CCP could be subject to the general clearing requirement should be left to the authorities. So we clearly see a role here in the general decision on whether a product should be cleared. Another issue in Europe concerns the ownership, governance and robustness of CCPs. Now, this ownership issue, which we know has come up strongly in the United States, is less of an issue for us for several reasons. First of all, we don't necessarily think that excluding some dealers from ownership of CCPs is necessarily the right policy. There could be very strong incentives for those dealers who do own CCPs to make sure that the CCPs are efficient and indeed safe and sound. But that's one argument. A second argument for us is basically my institution doesn't determine the shape or composition of companies. We do not determine ownership in any activity that we carry out in the European Commission, and indeed it's against our treaty. member states can decide the types of structures they want for the CCPs. Now, we are concerned in Europe that any movement towards clearing, and we all support that, should be robust enough to withstand any financial Armageddon. There are and will be more systemic institutions, and we have in Europe not just one, but several CCPs, as many as 8, that could be clearing this business, clearing trillions of dollars and euros of various derivatives. So who should be the regulator and supervisor here? What role for the CCP Risk Committee should we see? And indeed, should there be a backstop if there is difficulties and trouble in a CCP? Something, of course, I know that is very unpopular to contemplate, something that's very present in your discussions in Congress, but it's an issue we have to look at. I noted that Jerry Corrigan, who's immensely knowledgeable about these matters, has suggested that CCPs should be placed, that there should be enough safety in CCPs that if two major participants fail, the system can still continue and not collapse. So what is fail-safe? How do we define that? And how will the default mechanisms work, both in the CCP, and let's think about even more complex issues between CCPs, not necessarily just in Europe, but a default mechanism between a European CCP connected with a US CCP. Who's going to call that? Who's going to make those decisions? And we have other issues in Europe that perhaps you do not have here in the United States. One of them being, how do we get interoperability of clearing houses in Europe? We do not have a mandatory obligation for that today. Should this be a right, an obligation? Well, I think so. So we're going to have to mandate this in law. And then comes another question. Does this only equities or do we include derivatives? I certainly hope, and I believe we should be bold here and require interoperability across all financial products cleared in CCPs in the European Union. Ladies and gentlemen, we have other issues before us, issues of definition, issues of data reporting and data protection, issues of margin requirements and margin and position segregation. We've been hearing about that already very interestingly today. I come back to my basic point here. This issue is of tremendous importance for both the European Union and the United States. We are going to go the extra mile to try and converge our positions with you, with that positions emerging in Congress, as far as we can. I believe that's right. We believe that we will end up with safer financial markets, markets that will grow with a degree of safety they did not have before. And I believe there's almost an ethical duty, and I say that very strongly, between us to try and get this legislation to converge to the maximum extent possible. And once again, Commissioner Summers and Chairman Gensler, thank you very much for giving us the opportunity to put forward our views on these crucial matters in Washington today.
Thank you, David. I'm sure there's probably lots of questions, but at this point I'm going to turn to Terry Arbit from our Office of General Counsel, and Nanda Radhakrishnan is also here from the Division of Clearing and Intermediary Oversight, and Terry is going to give an overview of the proposals in the U.S.
Thank you, Chairman Summers, Chairman Gensler, and Commissioners. I'll try to be relatively brief so that we can leave more time for discussion among the committee members. Staff at the CFTC has been working hard on the legislative matters, not just General Counsel and clearing divisions, but all of our other divisions as well, market oversight, legislative affairs, international affairs. We appreciate the support of the commissioners that we've had for many, many months, dating back to Commissioner Dunn's tenure as acting chairman earlier this year. In the materials, I think there's a short, some call it a chart, some call it a table, but we've tried to summarize some of the issues that would be most relevant to trying to compare what's going on in Congress with the issues that we just heard about in the international perspective. This by no means is all of the provisions in the 200-page legislation.
Terry, I'm just going to help. It looks like this. It's a side-by-side, some people might call it.
Side by side by side by side. Yeah. And I think it's 7 pages long. And I'm going to try to just walk through those issues without getting into a great layer of depth on any of them. I think most people have some familiarity with them. Much of this side-by-side, I think, now is actually just of historical interest for those who've been following the events on Capitol Hill. We have several columns that talk about various bills from the House Financial Services Committee, House Agriculture Committee. But the key at this point in time this week is the right-hand column, which would be the Peterson-Frank substitute bill, which, as I understand the legislative process, will be the vehicle to go to the floor of the House of Representatives later this week, and that will be the OTC bill that people will be voting on and offering amendments on. So that's the column that I'll be focusing on primarily in talking about this. Just one other introductory comment on the chart. What we've tried to do here at the staff level is highlight those where there have been disagreements during the debate. And so you will see that there are some provisions that are vitally important, but that actually are not listed in the chart, swap repositories being a good example. There are provisions on repositories in the legislation, but they've remained the same from the administration's original proposal all the way through to the Peterson-Frank substitute. They are not very detailed, actually, in the legislation about repositories. They'll leave it up to the CFTC and the SEC and our rulemaking authority to implement those. But the chart, we tried to focus on those issues that had generated debate and controversy over time. And actually another example, sort of on the flip side of the repositories, though, another issue that is not in the chart, because there has not been a difference among our committees on it, but following up on the first half of today's meeting, is bankruptcy. That's, from what we heard this morning, earlier today, obviously a critical issue, and yet none of the bills that have been offered have included bankruptcy provisions in them. So that remains a gap really across the board, and that's why you won't see it in the chart. We have nothing to compare. So, but in terms of what is here, and the issues that have come up, these really do, I think, track what's going on in Europe. Certainly all the discussions we've had at the staff level with counterparts overseas, the same issues are coming up, and there seems to be harmony of approach at the staff level. What I'll try to do is summarize where Congress seems to be at least at the House of Representatives side. The first question, which always is sort of who's in and who's out, and there we have definitions of swap dealers and major swap participants. They are in. I'm not going to really focus much on swap dealers because I do think the critical one is probably the major swap participant issue. And the relevance here is primarily who will be subject to the capital rules, the margin rules, the business conduct rules, the reporting and record-keeping rules. That's the significance primarily of whether you are or are not a major swap participant. And the same issues that that are being confronted out in Europe are certainly being confronted here. The smaller the category of major swap participants, then some would argue the larger the loophole from the regulatory regime. On the other hand, sweeping in entities and firms that arguably should not be swept in is also not good public policy. I've heard there seems to be, at least in meetings I've been in, a fair amount of agreement on kind of what the concept is, but as reflected by the side-by-side, there have been an awful lot of efforts to capture that agreement, and I leave it to others to determine whether they've hit it yet. The general sense is that true risk management, true commercial hedgers should perhaps not be swept in unless that failure of a hedger, a firm like that, could have implications for other counterparties that are sufficient that they need to be brought into the regulatory regime. That seems to be the goal that most of these bills have been trying to hit, but they each have done it a little bit differently. The Peterson-Frank substitute is a formulation that hasn't appeared before in some respects. It's got some similarities, some differences. The key phrase that is generating debate this past week seems to be the references to operating and balance sheet risk, which would be a means to exclude firms from the definition of major swap participant, which again would then exclude them from the requirements of business conduct, record keeping, capital, and margin. So that's the general issue of who's in, who's out. We then get to a couple of issues, the clearing requirement and the transaction execution requirements, which are critical to the entire regime. Again, first on clearing requirement, there does seem to be the general consensus that as many transactions as possible, as many swaps as possible should be cleared. It's consistent with the G20 declarations. But we have the same questions here. Who is going to decide what is clearable, and what are going to be the standards for making those decisions? And again, if you just look across the columns of this chart, there have been a lot of proposals fashioned to do that. The current version, the Peterson-Frank substitute, does not specifically rely on notions of standardization, but it does have the concept of an active role of the regulatory agencies, the CFTC and the SEC. The regulators will determine whether a swap must be cleared based on various factors that would be in the legislation, and that can be done either at the request of a clearinghouse or at the agency's own initiative. But there does have to be a regulatory determination that a swap must be cleared in order for it to go forward. You then get to the issue of it's a clearing requirement, but what exceptions are there to the clearing requirement? And this is what we were just talking about, the so-called end user exception. It's similar to the major swap participant definition issue, but a little bit different. This goes to the question of who must clear their swaps. It's not so much the question of who's subject to capital and margin requirements. The question is, should there be any exceptions to the clearing requirement, and if so, how extensive should they be? Certainly some have argued that there should be no exceptions at all. Others have argued that there may be a room for some exceptions as long as they are narrowly tailored to try to capture purely commercial firms. Again, I think where the Peterson-Frank substitute comes out is, again, the critical language probably about balance sheet risk and operating risk. There's also a sort of odd requirement to staff here that in order to take advantage of the exception, there has to be a notification to the CFTC of how a non-dealer or non-major participant addresses its obligations with non-cleared swaps. There's actually no requirement that we do anything with that. We don't have to decide anything. We simply have to be notified of it in order for the participants to take advantage of the end user exception. That then leads into the question of an exception from the trading requirement. Generally, swaps must be traded on trading venues, either contract markets here or these swap execution facilities. But the question comes up, if the swap doesn't have to be cleared, does it still have to be traded on one of these trading platforms? Some have argued that the two are distinguishable, and even if it's not cleared, the swap should still be traded on the trading platform. Most of the bills, in fact, I think all of the bills have not taken that route. They have all provided one way or another that if the swap is out of clearing, it's also out of the trading requirement.
Terry, where I don't expect you to take a point of view as a Deputy General Counsel, but are they distinguishable? Just that point? Is a clearing requirement and a trading requirement from a technical legal point of view? Could you distinguish the two?
I think they could be distinguished.
Thanks.
The Peterson-Frank substitute, while it, like its predecessors, does link the two, but it does make clear that reporting is required. If the swap is not cleared, it doesn't have to be traded on one of the organized venues, but does still need to be reported. I'm really going to quickly just touch on the others. I think those are the key issues, the critical ones that probably are the most interesting for discussion. But just a couple of the others are the ones that are in the chart that have international implications. The Peterson-Frank substitute would give us here in the CFTC and the industry a new set of DCO core principles. These principles are consistent with international standards today. They were designed to respond to arguments by some that the existing core principles from the CFMA 9 years ago were not sufficiently robust. But in addition, under the substitute, the CFTC would also have rulemaking authority to supplement or change or adapt the rules for clearinghouses as time goes on. The next are these trading platforms, these swap execution facilities. This is an interesting area because I think the question that's come up is sort of what model these platforms are going to have. Clearly, the administration's bill was focused on a model of a trading platform similar to the Intercontinental Exchange. You'll see if you follow the flow of the chart that over time the definition of these facilities has expanded to encompass different models similar to the alternative trading systems on the security side, the voice brokerage type of business. And I think how that business relates to the swap execution facility, how that fits in, is probably an issue that really isn't fully resolved in the House bill and will probably be debated further when it gets over to the Senate. Position limits. All of the bills have provisions where the CFTC may set aggregate position limits that will include swaps, that will include Foreign Board of Trade contracts that are linked to U.S. contracts. The one thing I highlight in the chart is that the Peterson-Frank substitute also does include a requirement for the CFTC to set futures and options limits within a short number of days after the bill is enacted for physical commodities, the energy and the agriculture. So that's one place where the legislation is extending beyond swaps to cover futures and options as well. Foreign boards of trade. There are provisions on foreign boards of trade. Again, all of the bills have consistency that for a foreign board of trade that seeks direct access to U.S. customers, the legislation essentially codifies the Commission's current policy on what conditions will be imposed in that situation. Where they've differed, as you can see, is whether actual registration will be required of foreign boards of trade. The administration had proposed that there should be a registration requirement, which I think staff here thought of as kind of a registration light type of regime, but even that is not included in the Peterson-Frank substitute. There's not a registration requirement. The old concept of the multilateral clearing organizations under FDICA and the CFMA has disappeared in the Peterson-Frank substitute, although all of the bills have had provisions where the CFTC can exempt foreign clearinghouses that they find are subject to comprehensive supervision and regulation by appropriate standards overseas. And last, extraterritoriality, the last one on the chart. Concerns were voiced because neither the administration bill nor any of the others leading up to it had actually explicitly addressed the application of the statute to activities overseas. Concern was voiced, and the Peterson-Frank substitute does include a provision that specifically spells out that the law will not apply to activities outside the U.S. unless those activities have a direct and significant connection with activities in or effect on U.S. commerce, or if they contravene rules that the CFTC sets up to try to avoid evasion of the new law. I think that's generally consistent with the extraterritoriality provisions that already exist in the federal securities laws. That's the chart. I want to mention just two other things very quickly that didn't make the chart. But one I know is very important to everybody here and overseas, which is governmental access to data in the repositories. And the legislation is very clear that data that is in a U.S. repository is available to foreign financial supervisors, foreign central banks, and foreign ministries, subject to the confidentiality provisions that are in the Commodity Exchange Act already to protect futures and options type of information. And last, just to show the comment about how fast things move, it's not really day-to-day. Sometimes it's hour-to-hour. I finished this chart shortly before the meeting started, and as I came down here, I got a message on the BlackBerry that it's already obsolete. There have already been further changes, so I stand by my analysis, at least until it changes. But they did, the current version of the Peterson-Frank substitute does include a provision relating position limits, that the CFTC shall strive to ensure that trading on a foreign board of trade will be subject to comparable position limits, and any limits here will not cause price discovery in the commodity to shift to trading on the foreign board of trade. So that's currently in the Peterson-Frank substitute. And I think that was a quick run through the general international highlights, and I'll stop so that we can get to the discussion.
Terry, could you just expand on one area that I would think would be interesting to everybody, but particularly David Wright and his colleagues, is you talked about extraterritoriality, but when in the bill could the SEC or CFTC, or for that matter the prudential regulators under the bill, David, the prudential regulators set the capital standards for for these swap dealers. When could the SEC, CFTC, or prudential regulators rely on foreign regulators? Because the 12 or so largest financial firms that are swap dealers are all global in nature. When could we rely on them with regard to intermediaries? When could we rely on them with regard to clearinghouses and swap execution facilities? And maybe 3 different answers, I don't know. You might want to hit the button.
Thank you. One of the answers I'm not sure I'm entirely sure about. There are provisions for the CFTC to exempt clearinghouses and the swap execution facilities. We could exempt these entities if they're regulated by the SEC or by a foreign regulator. That's that language I was talking about. If we find there's comprehensive supervision and regulation by appropriate regulators in the home country of the clearinghouse or the execution facility, then the CFTC may grant an exemption. It's not automatic.
So it's comprehensive, appropriate regulation, and then we can grant it. How about the intermediaries?
There were versions of the bill that did not include that for intermediaries. It was for the trading platforms. I think that's the case in the final, but I will need to look at the final and make sure of that. But there were versions of the bill that drew that distinction, that not the intermediaries, but the exchange platforms and clearinghouses.
There's a lot of issues to cover, and I know many of you have questions and comments about several different portions, so I'll go ahead and open it up for, sure.
I just want to thank Terry Arbit and everybody in the legal staff. It's just an amazing job that, and Dan Bergovitz, who's here too, I mean, providing this type of document for this meeting, but well beyond that, providing technical assistance to the House, the Senate, Republicans and Democrats alike. It's just remarkable what you guys have been doing.
So I'll go ahead and open up the floor. Jiro?
Hi, my name is Jiro Kochi. Mr. Wright, just for clarity, I should say I represent about 400 end users, so we may have to agree to disagree. But you made a point in your document about how credit may have been undercharged as a result, and some of it was clearly evident in the financial crisis. And then in your opening statement, you mentioned that end users should pay for the cost, I guess, of the privilege of using this derivative market. I guess I'm trying to understand how you can clarify why the cost should go up. So if I look at, there's 200 swap dealers in the marketplace in ISDA, they're clearly making some profits from entering into derivatives. And from an end user perspective, when they enter into a swap transaction, they're looking at the overall cost of the banking relationship, and I believe it's vice versa. So you're looking at how much you're paying for your loans, how much you're paying in fees, and related to that, how much are you paying for the cost of entering into the derivative. So I'm just trying to understand if you think derivatives are underpriced for end users and the cost for margining and clearing should make up for the new price under the reform, or if I'm missing something.
Well, in our paper, and that's our only official position, what we clearly state here is that we want these markets, we want risk to be priced properly. I think it's a fairly heroic assumption to make that in these markets risk has been priced properly. You may say that. I think we fundamentally disagree. And if, as we all, I think, agree on the policy side that we want to drive more of this business to be cleared, drive it onto exchange, make it more transparent, etc., etc. If that is going to require more cost and a higher price for non-financial firms, then we think that is correct. We think that is entirely correct, and we believe that the benefits of that public policy will result in something that's pretty precious, and let's not forget the value of that, which is called financial stability. And let us not forget that this financial crisis, let me talk about the European Union here, where so far we have authorized expenditures to bail out the banking system to the tune of 31% of GDP. Not all of that has been used. Actually, we've used 12%. So there's something very seriously wrong here. I think we all know that. And some of that, not all of it, but some of it, we think has been because the pricing of risk in these markets has not been entirely correct. So this policy is going to possibly result in more costs for hedging positions. We've made it very clear that we do not want to cut off bilateral trading or bilateral custom-made derivatives. But again, we think that the risks require more capital to be posted. We're going to change our capital requirements directive to make sure that that is the case. If firms, whether they're whether they're dealers or market participants, decide that's what they want, and non-financial firms, so be it. But the cost will go up, and the cost, we think, has to go up in order to make the system safer. So, you know, there's a fundamental question here. We're not dictating prices, but we are saying we want a safer system. Yes, very much so.
I think this is an interesting and challenging issue, and as Terry captured it so well, although there may be agreement on which direction to head with the decision makers on Capitol Hill, capturing that decision in actual language has been the real challenge. On this particular issue, does anybody else have comments? George?
If the cost to the end user is going up because of the posting of margin, that could be offset through the transparency and the execution rules that much better executions become available. Or were you talking about specifically assessing some sort of charge to the users?
I think it's clear that we think that as more and more trading goes on exchange, then you would expect over time those additional costs I was referring to should decline. That's clear. But I've outlined a policy here which we believe is the right one, and we believe may and is likely to require and result in additional cost. Now, the issue then becomes, and this is the big issue you're debating, and we've just heard from your general counsel about who's in and who's out of this system. And we've noted very clearly what paragraph 4, talking about this triple cumulative conditionality about who's going to be inside this system and who's not. We will be looking at that as well. We have I think an a priori view that we want the exemptions to be extremely narrow, because we have a view, maybe wrong, but we have a view that if we have an open-ended system here, basically we'll end up with arbitrage and another shadow system with all the danger that will result in. So again, I think it's too early to say how these economic effects will play out. We're going to analyze this very carefully, and as we design our exemption regime, if we have one, but let's assume we have one. We haven't said we're not going to have one. We want to make sure that these new disciplines and their new disciplines apply as widely as possible.
David?
Well, I'd like to at least provide the perspective of the business end user, since I'm perhaps in the minority in the room here, but just make a few points. As a business end user, we clearly see the benefits of the financial regulatory reform, especially in the areas of increasing transparency and reducing systemic risk and restoring financial stability. Those are certainly all good things from our perspective. However, we're keenly interested in making sure that any new regulations not eliminate the important flexibility we think we need to effectively manage risk in our business. And so specifically, what do we mean? First off, we believe that business end users do not pose systemic risk to the financial system. And in fact, end users, trades represent only a small minority of the total sort of OTC derivatives market. We're not in the business of speculating and gambling for profit. It's not in our policy or our charter. We believe it's imperative that end users continue to have the flexibility to enter into bilateral customized transactions that best address the risk profile that we have in various aspects of our business and to mitigate that risk. And so we're clearly in favor of exemptions for business end users from central clearing and bilateral margining. Now, without these exemptions, we think we'd suffer the burdens of losing hedge accounting treatment in many cases for many of the transactions that we would engage in, which introduces significant earnings volatility to our P&L. It would also impose perhaps onerous requirements for taking capital away from what we would deem more productive investments in our business and in growing our business and employment, and divert that precious capital to cover things like margin requirements. So bottom line, we as a business end user support many of the benefits of the proposed regulatory reform, but we'd like to ensure that regulation not overreach and end up stifling or inhibiting the important flexibility we need to mitigate the risk in our business and to invest the capital that we need to grow our business.
Could I just ask, then we might have both a response, and thank you for joining the committee, by the way. You mentioned ability to customize. I ask you if you are familiar that the administration proposal and every bill in Congress that's been submitted so far since May allows for customized transactions. So that's a valid point you're raising. The administration supports it. Chairman Peterson's bill, Chairman Frank's, Chairman Dodd's bills, I think Senator Reid also had a bill, all supports that exact point. Is it some other point that you're debating? I think it is. I think it's saying that as an end user, you don't want standardized transactions to be on clearinghouses. I just wanted to separate what I think it is that you're raising. But customized transactions have been fully supported by the administration and by each of the committees. And if I'm correct, then the question of standardized transactions, by the way, you would still be able to get hedge accounting. I find that being raised, with all respect, is adequately addressed because you could customize a transaction and be able to get your hedge accounting. I probably come out a different place. I'm where David Wright is. I think that the taxpayers in this country have $180 billion in AIG. That's $600 each one of us has in there. And I know that at Boeing you probably had sales go off. You had to look at a year that was probably very much below your current budgets. So it hit Boeing, it hit every shareholder of Boeing, every employee of Boeing. And I don't know how many people you probably would have hired if employment was better in this country. So this calamitous situation hit everybody at Boeing as well. So I sort of more am with where David Wright is. I think we should have all standardized swaps and clearing. But recognizing maybe the votes aren't there in Congress. Maybe the Boeings and the others in this great democracy of ours will convince Congress not to do it. My question for you is, could you, as Treasurer of Boeing, support requiring that standard swaps be brought to a transparent trading venue while you're still exempt from a clearing requirement?
Well, Mr. Chairman, I guess I would have to make sure I understand the technical distinction you're making. I think that
here, I'll explain it.
Yep.
Trading is where buyers and sellers meet in the marketplace, where price discovery occurs, where information deficits that occur in the market right now are exposed, and where a transaction occurs, and then prices are reported, post-trade transparency. Clearing is something that happens for months or years after the trade that has to do with risk mitigation. Risk mitigation because these derivatives values change in value. Right now we have Wall Street, really 5 banks, that internalize both the trading and the risk management. And what I'm strongly recommending for the benefit of economic growth and efficiency in markets is that both are moved, but the trading side benefits. If every treasurer in America, every assistant treasurer in America had a screen and could see the pricing of interest rate, currency, commodity, equity, credit default swaps, the spreads would narrow. And economists say when spreads narrow, liquidity goes up. Wall Street will probably contend, no, not really. Liquidity won't go up. But I think you benefit as a treasurer of Boeing every time you're thinking about issuing debt, that there's something called, that corporate bonds are now reported in a real-time basis. I think you benefit when you do a share repurchase. If you were going to do a share repurchase and you didn't know where your stock was trading, you'd say the SEC wasn't fully doing their job. And if you were hedging something in the futures market and you were trying to hedge it and didn't know where the last futures price traded, you'd say we here weren't really fully doing our job. So what we're talking about is not small, it's a big thing, but it would shift an information advantage to you as an end user. And then let you decide with your counterparty whether you might keep the trade on the books with the bank, have your credit arrangement with the banks, as you do now, not be required to move it to central clearing, but at least have the benefit of the transparency.
Right. So what's important to us is that we be able to have that bilateral discussion with the bank, because some of our requirements are unique and long dated and end up.
You would have that on all the customized swaps you want. Absolutely.
Right. So what we're not wanting is to be forced into standardized transactions through an exchange, because that won't fit the risk sort of.
My question is you would completely have flexibility to do all the customization you want, but if you happen to do a standard swap, a 1-year interest rate swap that is listed on a trading platform, then the counterparty, the big bank, would have to, on that transaction, expose it to the price discovery function.
Okay. Well, it's certainly something we'll consider, but you understand that what's important to us is to be able to have this. And I think fundamentally, I mean, you mentioned AIG.
Can I ask you, what wouldn't be good for Boeing and your employees and your stockholders of that?
I'd have to think about it, Mr. Chairman. I think that fundamentally, again, it's the ability to customize. The ability to get hedge accounting, because that is important to us, the earnings volatility issue, and the ability to not be required to post margin because it does take capital.
I've said yes to every one of those.
Okay.
I can't understand how this wouldn't be an unabashed good thing for you.
Right. And I'm not sure that it is, but let me get back to you on that.
Thank you.
All right.
It seems to me that the possibility that you raise of trading standardized swaps which are not cleared in a central marketplace really highlights what would then be happening, which is you would then be giving the liquidity providers of those swaps the ability to tie together simultaneously the pricing of the derivative and the credit component implicit in not requiring collateral. Some people might say that that's anti-competitive because you're tying together multiple services at the same time, and doesn't seem like the right approach. The better approach seems to me to be to recognize that issue and to split those things apart.
Thank you. Donald could come to a judgment.
David, did you have a comment?
Well, I very much agree with what the Chairman has been saying here. Again, our position is, I want to just read out one or two passages because maybe to reassure my colleague on the left here, we're not saying that there shouldn't be any customized derivatives trading in the future, but we want that trading to be properly priced. and we intend to, because we believe is much safer to trade as much as possible and to clear as much as possible, we are going to provide incentives by requiring more capital to be posted for this type of trading in the future. So that is a deliberate policy choice, and it's a policy choice for financial stability, and I repeat that point. So secondly, let me say that we clearly state in our papers that we do not and will not put forward policy which prevents Boeing, in your case, sir, or anybody else, from managing the risks in your business. We're not saying that. And what we say about variation margins is the following. Variation margin requirements, if needed for financial firms, should be tailored in such a way that they do not undermine the corporate sector's ability to use derivatives for transferring risk, especially in the case of companies whose use of derivatives is below a threshold. So there are signals there that we perfectly understand the issues you're raising. But there is a much broader point, and I come back to the broad point, and I come back to the economic damage and the financial stability issues here. That is what's really important. And we believe, as the chairman has said, the more transparent the markets are, you and your firms in the end will benefit from that by tighter spreads, by more transparency, by understanding exactly where the market is. So we want to encourage those trends. We want to clear transactions because we believe it's much safer. And we want the CFTC and our parallel regulators and supervisors to have full information about what's going on in these markets. And that was not the case in this financial crisis. So I don't think we're closing off what you want to do. We're just saying there's going to be an economic price if you don't do it in the more so-called, inverted commas, standardized way or through clearable transactions.
George.
Taking this Boeing hedging example that has been discussed, I think I heard two different things. Chairman Gensler was saying, no, they won't have to put up margin for their customized bilateral long-term derivatives, and Mr. Wright is saying, yes, they would. No?
No. You didn't listen to me. I said variation margins if needed. I said if needed. So first of all, that's not a position.
That's variation margin, but you also talked about an additional capital.
So it depends in terms of the U.S. It depends on the definition of this famous category here under number 4, is it not? About who is covered by the exemption.
I guess I'm still confused because I thought I heard you say that a bilateral, negotiated, customized swap transaction, that a capital deposit would be required.
Well, clearly, what we're saying is that where there's OTC trading, we intend to change the capital requirements rules. So those for banks. So clearly for banks, who will be required to post to have more capital for that type of trading, for the stuff that cannot be centrally cleared. And the Basel Committee right now is looking at that. So that, of course, will, in a sense, add to the cost, or potentially add to the cost. And that price, you would imagine, would increase for the OTC transactions.
And just to clarify, if you like, the administration and this commission, because I testified on behalf of the full commission before Commissioner Malia was here, has been supportive of customized transactions that individual hedgers, whether it's Boeing, whether it's small, whether it's large, or even individual speculators, would have an ability to tailor their over-the-counter derivatives and enter into bilateral transactions after any legislation moves forward. The banks providing that service would have capital charges and possibly margin, but certainly be able to provide those customized, tailored transactions to both hedgers and speculators. What I think really the debate is over is that part of the market that can be cleared, or that part of the market that's listed on a swap execution facility. It's so standard that it can be cleared. Is there a requirement? And what I was raising is I think the two are separable. And as our general counsel's office, Terry Arbut said, it can be separable with Congress's help. I think that was what I was trying to elicit from David, is that I think the legitimate issue that end users have raised about their costs, I side with David Wright. I think it's important not to shift that cost to taxpayers. But if Congress decides to have an exemption for end users from clearing, which I understand may well be what develops, that's what's part of our great democracy, I think that the transparency part of it is something that corporate America has an opportunity right now to influence this debate in a positive way to your bottom line. I'm appealing to your fiduciary duty. I think you should shift that information advantage from the Goldman Sachs's to your left to the Boeings. And there's 5 firms right now that are dominant in this country, in this business. I would think you'd want to shift that information advantage to the thousands of end users.
I'd just like to clarify that I really agree with everything you've both been saying about the benefits to the end users and, of course, to our financial system. I'm not quarreling with it at all. I agree with it entirely.
Joe, can I make...
Is there anything further on this issue, Mike? Did you?
Commissioner, this is Jim Newsom. Can I make...
Jim, we can hear you.
Okay, thank you. Certainly, even though I'm on the board of the CME, I don't speak on their behalf. I think the management of the CME has done that quite well throughout this whole debate with both the Commission and the Congress. And I, as well as I know the CME management, has supported the overarching goals of the Congress and the administration to reduce systemic risk. And certainly, I completely understand the conversation here between standardized and customized. But I think on behalf of the clearinghouse standpoint, I wanted to raise an issue with regard to standardized contracts and get both David and the chairman's view. And I think even behind that, the CME has supported the benefits of central party clearing. There's been discussion about whether it should be mandated or whether it should be incentivized, and I won't get into that right now. But contracts that are standardized, even though they are standardized, if they're very infrequently traded, makes it extremely difficult for the clearinghouse to clear, because it's difficult for the clearinghouse to calculate collateral requirements consistent with prudent risk management. I mean, how would you deal with even standardized contracts that are very infrequently traded when it creates a lot of difficulty for the clearinghouse?
Oh my God, David Wright wanted me to go first. Hi, Jim. It's good to chat with you, even over the phone here like this. And it's an honor to be in the job you once held. I think that what the House bill contemplates, and we support, though there's been various alternatives to this, is sort of a two pieces to this, that the regulators, the SEC and CFTC, and the clearinghouses have a role to play in these determinations of what's clearable. But both have a role to play, where the clearing decision is an important one, but it all has to be under robust risk management standards. And one of the key things, I believe, to robust risk management is that a clearinghouse can adequately price the transactions, because clearinghouses mark-to-market transactions on a daily basis and need to have some ability to do that. That's far more accessible in the rate markets, interest rate and currency markets, less so in some of the credit markets and commodity markets. But I think it's central to the question of what is clearable is how well you can risk management a contract. So I suspect there's not going to be, I think there will be a mutual interest between regulators and the markets to make sure that the clearinghouses are robustly managed, and that anything that is deemed to be clearable is done with that in mind. Also, the bill contemplates a public comment to it. I think, if I'm right, Terry Arba can tell us that if a clearinghouse asks something to be cleared, or if the SEC and CFTC wants it to be cleared, we have to put it out for comment for, I think, 30 days maybe in there, Terry?
Right, that's right.
And though that was recommended by people in Congress, I fully support that. I think that's a good idea, so that the marketplace will be able to comment, and then a determination would be made as well.
Mr. Chairman, I think that flexibility, in very unusual circumstances like the one I mentioned, would be very useful to both the Commission and the clearinghouse. And let me finish by saying I'm glad that I'm not sitting in your chair right now.
Very, very briefly, I think we have a similar philosophy to you here. I think it's clear that there is a role both for CCPs and, of course, ultimately the regulators. We've got to avoid a situation where we have a so-called standardized product, but the CCPs say, look, really, we don't think it's right that this should be centrally cleared. But clearly the regulators at the end of the day have got to make, in our view, general judgments about whether products should be cleared. So we're struggling with this issue. We're struggling about how it works. We can see some dual responsibility here. At the end of the day, of course, I think it is the regulators, supervisors who have to decide. And let's be clear here. We've got to pay a lot of attention to the CCP's views, because we've got to be extremely careful about this concentration of risk and default, and backup, and so forth. Those points that I mentioned earlier. And so robust standards and robust standards for CCP is going to be absolutely essential. But we're thinking our way through this. But I quite like the process that the chairman and council were outlining here.
Is there anything else on those particular issues? I know Mike had.
Just a statement on that, and then I'll go to another question, and that is, I think it's the intent of Congress and certainly this regulator to tell the whole world that the days of cheap risk aversion with the taxpayer as the backstop is over. Now, the good news for the end users is the overpricing of risk management should be over as well, and you should understand more closely what you're paying for and have some options there. Now, I'd like to change the subject matter here. And David, when you were talking about the EU's process, and you laid out that the first year you will have a proposal ready, then it will probably be adopted sometime mid-year. Let me follow up on that, because by the time it gets down to the provincial regulator, the FSA and the BaFin, the CFTC counterparties, what date do you see promulgation of regulations?
Well, Commissioner, it's rather like asking you the exact date when the Congress will agree on your package, but our best estimate at this stage is that we would hope, with good preparation, good coordination, impact analysis, that if we put forward the main legal text in the middle of next year, we would hope, given the urgency of these issues, that we could get these texts to be entering into force around in 2012, and probably towards the end of 2012. Now, that sounds a long time. It's possible we could go faster. We have different legislative techniques here, and we would certainly want to go as fast as possible. But we have an important deliberative process. We have two chambers, member states and our European Parliament, who have to debate and decide on these matters. So this takes a lot of time. So I'm hoping that within a year of our tabling this work, tabling these proposals, we could get agreement. And if we put them in the form that they're directly applicable to the member states, that sometimes can speed up matters. So I don't want to promise that anything will be implemented in community law before 2012. I think that would be the earliest. Now, we will do everything in our power to make sure that we move as fast as possible. And I believe our finance ministers and the European Parliament understands the urgency to move as quickly as practically possible.
Given that case and the fact that Congress really appears to be fast-tracking it for the U.S., and I know our chairman wants to fast-track our regulations here, what assistance can we assume that we will get from the EU if we begin seeing regulatory arbitrage taking place?
That's exactly, that's exactly the point, isn't it, Commissioner? And first of all, I think what's important is that where we start, where our proposals start, I hope will be as close to your positions as possible. We will defend those positions extremely strongly. Assumption being that we can make a good economic case, and I think, as I pointed out, I think we can make a very strong economic case. And then we have to make sure, but there will be a transitional period. I think that's what you're hinting at here, a transitional period where the law in Europe will not be as converged as we hope it will be eventually with the laws in the United States. And that is, I think, something that we'll have to be very practical about on a day-by-day basis. And maybe that's an issue once you have agreed your laws that we should talk further about with our securities regulators and indeed even our banking regulators. But I can't take positions on that. But I see the problem, and I see this transitional phase when you will be applying laws which we won't in Europe. That is something that we will have to manage in one way or another.
And though I think Commissioner Dunn is accurate that this chairman wants to move quickly, because I think the American public deserves no less. I think our taxpayers stand exposed every day we don't do something. I mean, let us not forget we had the worst financial crisis in 80 years. And while these are complex markets, while it's important to get the balance right, we need to do this. I do think we'll have a transition period as well. The legislation as drafted in the House and the Senate provides a period of time for the SEC, the prudential regulators, for the CFTC to write rules, sometimes 6 months, sometimes 12 months. So if the bill, as I would hope, would be signed into law early in 2010 sometime, we'd probably still be writing rules well into the latter part of 2010 and into 2011. Now, depending upon the rule and the different part, there'll be some transition, but probably into late in 2010 and early in 2011.
Let's recall here, Chairman, that of course the G20 has dealt with this matter. The G20 says that we must all get our regulatory systems in order and convergent by the end of 2012, which was the date I signaled to you. I appreciate that you will have a lot of what we call them implementing rules implement and decide on thresholds and whatever limits you're going to define for the major market participants. So that's going to take time, and maybe there's some hope we could catch up a little bit here. But there will be, I think we've got to be realistic. There is going to be a transitional period when your laws will be applying and we won't have community law in place. And I think we have to think about how we avoid regulatory arbitrage, for example, in that period. I hope, I'm confident that our leaders in Europe would not want to take advantage of that situation. I think it would be immoral and totally undesirable in the context of solving these problems.
Director General Wright, both sides have proposed trade repositories, and I think Terry mentioned that U.S. law is going to provide full cooperation in sharing that data. Will the EU provide the same level of cooperation?
Absolutely. We think that's essential. What's important here is, first of all, the principle of using trade repositories. Secondly, we would hope that we will set up systems here for authorizing and supervising third country repositories on the basis of the types of techniques you were suggesting earlier on, which we call equivalence provisions. Heard General Counsel suggesting that might be part of the Frank Peterson bill. What's important, I think, is here is that our supervisors, let's assume that these trade repositories are going to be in the United States. What's going to be absolutely fundamental for our supervisors and regulators is that they have unfettered access to the information they need to supervise and regulate those markets. Now, that has to be unconditional, has to be uncomplicated. If it is problematic, then I can imagine pressures building up very quickly to say, well, we can't get the information we need, we're going to have to set this up in Europe. I would hope that that would not be the case and that there would be full access. So I'm a big believer in regulatory cooperation and supervisory cooperation. We would, I hope, see repositories, not necessarily in the United States, but subject to high standards, and as long as we have access to the global information, there should be no, in my view anyway, no location requirement.
Mr. Wright, I was wondering if I could ask your perspective, if I may, on issue number 9, which is registration of foreign boards of trade. At NYSE Euronext, I believe we're uniquely positioned to give perspective on this issue as a global multi-asset class exchange group. Our strong view is that the current CFTC no-action regime, based on the principles of comparability, has been extremely effective and appropriate, and it's remarkably similar to the FSA ROIE, Registered Overseas Investment Exchange regime. Our concern around registration of foreign boards of trades is that, of course, if it's done in one jurisdiction, there could be reciprocal actions in other jurisdictions, and that you could put up artificial trade barriers between the primary trading centers, and that would be damaging for a number of reasons. On our life exchange in Europe, 1/3 of our volume comes from U.S. clients, so anything that has the potential to block those transatlantic flows, we would view as being destabilizing and unproductive. But also, you have mentioned many times that we need to avoid regulatory arbitrage, and that as we move away from the financial crisis, that we need to work more closely together as international regulators, and that potentially putting in these registration requirements could work contrary to that. So I was just wondering if I could get your perspective from Europe on that issue.
Well, first of all, let me take the general point here about mutual recognition, and I'm talking particularly about securities business and exchanges. You'll be perfectly well aware that we've been arguing for years from the European Commission on behalf of our member states that we should work with the United States to work out mutual recognition regimes. And I guess it was about 2 years ago, even a year ago, perhaps a bit more than that. But we were getting somewhere. We were working very intensively with our colleagues in the SEC, and then the crisis hit us full on, and of course priorities shifted elsewhere. So we are and have been for many years very keen to develop mutual recognition regimes for exchanges, for investment business, but without any criticism, we found that approach not to be always fully welcomed and developed here in the U.S. We've tried. We've tried. Now, in terms of the CCPs, we have a view here which is that CCPs have a different function, and there are systemic issues involved here. And our thinking at this stage is that we would want CCPs, certainly some CCPs, to be authorized and regulated in the European Union. And of course, once we do that, once we come forward with these laws next year, the UK scheme would be replaced by an EU scheme. Now, we're going to listen to all the arguments here, but absent a mutual recognition regime, which as I say, has not been because we haven't been trying. We think because of the systemic issues here, we're going to have to consider, and I say consider because we haven't finalized our policy, that the CCPs should be in Europe. So we have an open mind. I'd like to move forward on a broader context. We've done that in the past with the CFTC. We haven't been able to move forward as fast as we want with the SEC, but we think the way forward in the future is to build up strong regulatory and supervisory systems, both in the US and in Europe, and to mutually recognize each other and trust each other. That's the right way forward. But for legal reasons in the US and for these are complex areas of policy, we know that. That's going to take time. But on the CCP side, we do have some concerns, systemic concerns. And, we come back to that question I asked. Do we need a backstop for CCPs? Well, if we do, who's that backstop going to be? It's going to be the European Central Bank or the European Central Banks, other European central banks, one form or another. So that's where we are at the moment, and we're listening to all the arguments.
Just to recognize that this CFTC has had our mutual recognition program in place for over 20 years, and we have talked about this issue for a lot of years and recognize that we think what we have in place works well. Codifying it may be the direction that we're heading. And Tom, I didn't hear in your comments that you would have a problem with codifying what our current regime is.
No, I tried to be very specific and say that the current regime we view as effective and appropriate.
Thank you, Tom.
Tom, one form of codification would be to call it a registration. It would be a different registration, similar to what I believe the FSA has. It has two forms of registration, one that you're probably familiar with, which is their fully regulated regime for entities there, and another is for these foreign, from their perspective, foreign boards of trade. We've had a no-action process where one way to codify that no-action process is to have Congress make a registration requirement for foreign boards of trade, but it would be consistent with what we've been trying to achieve with some enhancements, of course.
I think I heard Jim making a comment.
Yes,
Jim?
ma'am, thank you. Going back to the administration's goal to reduce systemic risk through central clearing, got a couple of questions. Maybe Terry Arvett may be the best to address, and I'm thinking again from the clearinghouse standpoint. Terry, is there anything in either of the legislative bills that would impair a clearinghouse's ability to respond immediately to a swap dealer default? And secondly, would all customer collateral be protected in the event of a swap dealer bankruptcy?
Jim, this is Ananda. Can you repeat your first question, because we have problems hearing you?
Hey, Ananda, yeah, I'd be glad to. Is there anything in either of the House or the Senate bills that would impair the clearinghouse's ability to respond immediately to a swap dealer default?
To a swap dealer default? No. I don't see it, no. No. And then your second question is?
Yeah, would all customer collateral be protected in the event of a swap dealer bankruptcy?
That we haven't seen and I think the chairman alluded to that, we haven't seen, or Terry did, we haven't seen the bankruptcy piece of it in the legislation. Nor have we seen any, and correct me if I'm wrong, Terry, nor have we seen any provisions relating to segregation of funds.
Well, there is some segregation.
But
there is some segregation.
There is some segregation, but we haven't seen the bankruptcy piece, I think.
Right. Yeah. Do you think there will
because
be a
I think
will that be punted another time?
Jim, this is Terry. I don't think it's going to happen on the House side if they're going to the floor this week. We've had discussions with Judiciary Committee staff on the House side. Chairman Gensler, in his letter to the Hill last August, supported bankruptcy provisions and provided some sample text, and we at a staff level very much support it. So we would do everything we could, but as to whether it happens, that's out of my hands. But.
And Jim, Gary here, I think on the first question, some earlier versions of the resolution authority, not the derivatives bill, but the resolution authority, stayed any obligations under contracts up to 5 o'clock on the day after a default, which I was asked to testify on broader matters, but raised in congressional testimony in front of the House Agriculture Committee, a very real concern that should be that should not go to margin and obligations under clearinghouses, that would in fact undermine the clearinghouse's ability to move quickly. What I don't know is whether that's been modified. We recommended the modifications to the Hill. We still believe those modifications should be that clearing obligations of defaulting swap dealers should be able to be quickly closed out, and that it's actually destabilizing if there's a 36-hour stay.
If I could just one more note on the bankruptcy, the Peterson-Frank substitute does include a provision that the Financial Services Committee had adopted. I think it's 180 days the SEC and the CFTC need to report to Congress on changes that we think should be made to the insolvency regime with respect to swaps. So but that's as far as it goes at this point.
Well, I think as the discussion earlier demonstrated, if we had a segregation and insolvency regime for cleared swaps, which is very similar to, if not the same as that for futures, then we could possibly take care of a default situation in a similar fashion to that which happened in Lehman. But absent one of those, then I don't, it might just be making the situation worse, if not, as opposed to making it better.
I agree. Thank you.
Commissioner Chilton.
Now, I was going to ask questions about timing too, but Commissioner Dunn sort of
ask it, and that was helpful. But I did want to not only join my colleagues in thanking David and your colleagues for being here, but say how impressed I am with the document that you have, and I'm struck by the similarities in a lot of them. And so I'm particularly pleased to hear you talk about comprehensive fashion. You talked about Forex. We've talked about metals a lot of times. I think we need to include metals. But just a very impressive document, and I think part of my message, my takeaway from this is we're actually moving in tandem on a lot of these things. Like I said in my opening statement, I'm not as concerned about who goes first, sort of like everybody's sort of jumping in the pool, everybody's sort of scared at first. I wanted to make a clarification, too, because the chairman talked about the timing on the legislation, which I think he's probably right. It's probably the end of the first quarter when we might get legislation from the Hill dealing with the OTC market. But that doesn't mean that we may not move forward, and none of us can prejudge what the commission will do, but with regard to position limits on current markets. And so I didn't want anybody to think that we were talking about a year from now there. And as I said, I think, if you go forward in a reasonable way, if you, for example, err on the high side, that this potential of regulatory arbitrage, which I think is a real concern, Commissioner Dunn's raised it a number of times, that maybe that's not as large a concern if you're not clamping down so devastatingly tight that people say, I got to go someplace. I got to go to the OTC market before it's regulated, or I'm going to go overseas. And so I think, like I said at the beginning, if you have a middle of the sort of road, figuring out how to go along, putting on appropriate guardrails, that this sort of stammer stepping between the EU and the U.S. can actually work out very well. So kudos to you all for what you're doing, and thank you again for being here.
Don.
I'd like to raise a different concern, which has to do with the definition of swap dealer in the current legislation. It currently defines as a swap dealer anybody who makes markets in swaps. And swaps are defined as, very cleverly, anything commonly known as swaps. Therefore, even a market participant...
You like that, Don, huh?
It's not very technical, but anyway. Therefore, even a market participant that provides liquidity in a swap, which is centrally cleared, will be defined and regulated as a swap dealer. And yet, the Treasury says in their discussion of regulatory reform, which was kind of the precursor to all of this legislation, that derivatives dealers who create large exposures to counterparties should be subject to a robust regime of prudential supervision and regulation, and hence this whole concept of a swap dealer. But clearly, a market participant that exclusively makes markets in cleared swaps and does not make markets in bilateral swaps, which coincidentally is the category in which DRW falls, should not come under this new set of regulations which is being created to prevent another so-called AIG.
Maybe, Don, we've agreed on a lot of things today, but this one I might take a little bit different side, and it's just one person's view. I'm not speaking for the Commission. But I think just as we regulate all broker-dealers, whether they're the largest multinationals or the smallest, and there's about 6,000 broker-dealers that hold themselves out, we regulate futures commission merchants. I don't remember our count, but it's the largest to the intermediate size. If somebody holds themselves out making market and swaps, we want them to be under the full record keeping and reporting with an audit trail, the business conduct standards. And it may well be that the capital standards would be quite low if they're all cleared. As you said, they might all go to clearing. But I think to bring the registration and regulation only to the 5 big houses and not to other swap dealers, if they're really swap dealers, they're dealing in swaps and holding themselves out to the public, making markets in swap, the business conduct, record keeping, reporting are valid. And it's a way to get consistent, uniform rules to a marketplace.
I mean, I'm particularly focused on the instance where a market participant may just be making electronic markets in swaps. So there's no issue of holding out necessarily, although they may enter into a market maker agreement with an exchange. But they're just posting prices electronically, just like they do in futures markets. And by the way, in that instance, from an economic perspective, there's probably not a lot of difference between something called a swap, which is cleared, and something which is called a future and is also cleared.
Well, I'd imagine that we'd allow ourselves a chance to debate this as we would go forward in rule writing, because I think the statutory language allows us to define swap dealer as well. But conceptually, and I can't speak for future rule writing, I think that it's more than just the 5 big swap houses if you're really holding yourself out to the public making markets. But I haven't thought through the specifics of, as you say, electronic market making of some sort.
We only have about 10 more minutes left of the meeting today. If anybody else has any issues they'd like to bring up.
May, one comment. Thank you very much for your kind comments, Commissioner, about our position, which, I've been doing this work for 10 years, and I believe that this is a classic area where if we can do a good job together, and I mean that, converge our outcomes to the maximum extent possible, given the differences in our political systems, we actually de facto set the world standards here. This is not just EU, US anymore, it's G20, we have emerging countries, we have the lion's share between us of these huge markets. So this isn't just a bilateral discussion, actually. It's a global discussion. It's a G20 discussion. And what is true here, by the way, is true in many other areas. I could list many of them, accounting standards or investment services, banking, you name it. And I do think here that this is perhaps one of the best examples where we have a unique opportunity to do a job of work to make the financial system more stable. I'm repeating what I've said earlier, but from my position, from our position, that's how we see this. And we are going to do everything we can and hopefully convince you about 1 or 2 points, and you will certainly convince us on some other points that we end up in a closely synergistic sort of outcome. And neither of us can promise what our political systems can deliver, but I think if we say, well, look, our position, both justified economically and justified politically, justified strategically, is very similar to the United States and vice versa. I think it sustains. I think it sustains our positions with our political authorities.
Thank you, David. Do any of my fellow commissioners have a closing comments?
Well, just one other point I was thinking about as you were saying that, David, is that reduces the ability for regulatory arbitrage at other places around the globe, that it won't be a race to the bottom. And even if it is, it would be temporary and short-sighted. So if we do these things in general together, as you say, in tandem, I think that's going to be great for the world. So thanks. And thank you, Jill, and thank your staff, Marcia and Andy, for doing a great job on this.
Yeah, I want to thank all the participants. It's my first GMAC meeting. I want to thank Jill for hosting this meeting. I particularly want to thank David and Patrick and Sebastian and Peter for making the trip this far. I think it's really added to both our knowledge and our debate here at this critical time as our House takes up critical legislation, and the Senate, no doubt, will follow if the House, as I surely would recommend that they do, is in passing this historic reform. And I continue to be very optimistic that we have a consensus here to bring the transparency and lower the risk to the system. And moving forward, I want to thank the members of the press corps. And maybe David didn't understand that they were all here, but I think they probably too heard that we really do have quite a consensus here, grappling with similar issues and though different political systems, that it's important that we end up, it won't be exactly the same, but largely the same, will be a very important accomplishment for both of our publics.
Let me join my colleagues in thanking Chairman Summers for an excellent meeting. I have found this most informative and very, very, very helpful. David, I'll let it be known that we're letting you off a lot easier than you let our chairman off. When but I do, the question I ask you, what assistance you would provide us if we did see regulatory arbitrage, I'd like you to seriously think about that and see what kind of feedback you can give us in that arena. Again, for all of your staff, Madam Chairman, and the staff of the International Division and our General Counsel's Office and our DCIO group, thank you all for putting together this fantastic meeting.
David, thank you very much for coming. Your testimony and your observations were very informative about how our two countries and well, at least the EU and this country can go down a path together. So I appreciate that. And thank you, obviously, to all the participants, International and DCIO, that gave us some good presentations on Lehman. And then, obviously, Jill and your team that put this together. This is very, very informative.
I also just want to echo all of the thanks to you, our colleagues from the EC, for being here. I mean, I think from certainly the entire GMAC's perspective, this kind of discussion is at the heart of why this advisory committee exists. So we much appreciate you being here today and engaging in the dialogue with these particular market participants, because it's very helpful to this commission. And also thank you to all of the staff from the CFTC who participated, to Roger Liddell and Ron Filler for being here today to help us in our discussions of these very important issues. So the meeting of the GMAC committee is adjourned. We hope to schedule another meeting maybe in late spring to early summer, and we'll try to get on your calendar at an early date this time. Thank you all for being here.